Good morning, Vietnam! I am not Dwight Schrute.
I am not Dwight Schrute or Michael Scott. I'm John Gallo, and I'd like to welcome everybody to the 8th Annual UHY Construction Outlook. Hopefully everybody recognizes that clip. It's from one of my favorite shows, The Office. I love that show, watch it all the time with my wife. And I was putting together my presentation, I turned to her and said, remember that episode where Dwight was supposed to get on stage and do this big presentation and he was nervous? Michael Scott ran up to the podium and started screaming, "Good morning, Vietnam." He's like, that's great. That's what you need to do. You need to sprint from the back all the way, jump on stage and just start screaming, "Good morning, Vietnam." And I said, hold on. Number one, I don't sprint anymore. It's been a long time since I've been sprinting. And B, I'm not going to come down to the DAC at 7:30 in the morning and he's screaming at the podium. So instead, I opted for a video. So, again, I'd like to thank you for coming. We have a very full-packed day of speakers, and I think you're going to really enjoy it. First off, a little administrative items to take care of. If you need CPE, there's a list out front on the desk. Make sure you sign that. At the end of the day, you can pick up a certificate for your CPE that you can take with you. Questions. So as we get started, each person's going to do their session. At the end of the session, we're going to have a short window for questions. So what you have in front of you is a pad of paper and a pen. What I recommend is jotting down that question, because if we start getting tight on time, we want to get you guys out of here, in a timely manner. So we might not be able to get to all the questions, but at the end, you're welcome to come up, talk to one of the speakers after, so you don't forget what your question is, or at the very end, you'll be able to email any one of us, and I promise we're going to get your question answered, and we'll get an answer back to you. One of the things that somebody had asked me was, what about the slides? I don't have a handout. That guy is a very old school guy, just like me. And when I mentioned that to Jessica, she said, John, you know how many trees we would kill if we had to print all those presentations out? And me being an old school guy too, I said, well, wait a minute, I got an answer for that. We have all those blue bins in our office. We recycle. Isn't that the answer? So it's okay. And she said, John, 2019, we're digital now. So at the end, you'll be getting a follow-up email that'll have a link. Click on the link, you can print out, if you're old school, many copies of the presentation that you want. You're going to be able to do a online little feedback, which we really appreciate. We take those very seriously. Helps us make this presentation better and better every year. So with that, our first speaker is John Shoemaker. John, ready? So the other thing that Jessica mentioned to me was, John, are you going to be giving a little bit of color behind the speaker and giving an update? And I said, well, who knows yourself better than yourself? So John's going to give a little introduction about his background, and he's going to talk about opportunity zones.
Good morning, everybody. Thank you for the introduction, John. For those of you that don't know me, my name's John Shoemaker. I've been with UHY for 9 years now, focusing in the tax realm. And about a year and a half ago, Tom Callan, for those of you that know him, came to me and asked if I would take the lead on opportunity zones, as this was part of the Tax Cuts and Jobs Act. I certainly volunteered for it, and since then I've taken a leadership role in understanding the sets of regs that have come out since the Tax Cuts and Jobs Act. And for those of you that were here last year, we walked through, really the code section as it was written. And since then, we've had 2 sets of regs come out. The first set were really helpful. The second set, which came out in April of this year, were primarily helpful, but there's one huge pitfall that people really need to be aware of. And so with that, we'll get started. On the agenda, we're going to talk about a little bit of a refresher to remind people that were here last year what these opportunity zone investments are. We're going to briefly go over what the first set of regs included, and then we're going to spend most of our time talking about the second set of proposed regs. Here's a list of acronyms. If you need copies of the slides, I have no problem providing them to people. But this is there's a lot of acronyms used, especially when you read about this stuff online. Usually QOF is going to be the most common thing you see because that's the fund where you're actually making the investment. The highlights of this, one is that you get to defer your capital gains. You're going to get up to, at this point, a 7-year deferral. 2026 is when you would recognize those gains. But that's really where this entire investment starts at. You have to have a capital gain, and then you're going to invest that into a qualified opportunity fund, get a 7-year deferral now on your capital gain, and potentially a 10 to 15% permanent exclusion at this point. And really these were put in place to invest in low-income areas. So a lot of people, when they talk about this and they really start to look into it, they're saying, well, wait a second, I'm taking a substantial risk in investing in some of these low-income areas. That's kind of the idea here. But as for anybody that's looked at an interactive map, you'll see that a very large portion of Metro Detroit is a qualified opportunity zone. So it's not necessarily as risky as you think it may be. Some more definitions. So you're going to invest into a qualified opportunity fund. Think of that as your holding company. And then the qualified opportunity fund can turn around and either invest directly in qualified property, which is business property used in a qualified opportunity zone. You can invest in stock or a partnership. And those are really just going to be more or less operating entities that are held underneath your holding company. The fund itself can't invest into another fund, but the way we structure these is you invest at the fund level, and then underneath it, you set up the operating company that's really going to be the one performing work or providing services within a qualified opportunity zone. And like I had mentioned, in 2026, that's when you're going to recognize your gain. The best way to look at it, you have a capital gain today, you defer it till 2026. On that date, you're going to pay the tax on that gain. But if you hold your investment for 7 years, you get to reduce your gain by 15%. To get to that point, you would have to invest by December 31st, 2019. If you invest after that date, but before 2021, you're going to get a 10% exclusion on your capital gain. And then anything after that, you're just going to pay the tax on your capital gain with no exclusion. Some very important dates. So like I had mentioned, the last day of this year is the last date to get the full 15% exclusion. And then 2 years from now will be your 10% exclusion date. 2026 is your gain recognition event. And lastly, 2047 is the last date that you have to sell your investment. So to reap the full benefits of this, you invest into a fund and you have to hold your investment in the fund for at least 10 years, and any long-term growth is permanently excluded. But by 2047, you have to sell your interest to get that permanent exclusion. So the first set of proposed regulations came out last October and provided a lot of much needed guidance. For anybody that's ever actually gone into the code section as it was written, it takes you about 5 minutes to read it. It's very short. The regulations that have come out are substantially longer reads. The most recent set was 168 pages. So So a lot of really good information came out of these that we'll go through. First, it defined what a capital gain was. The code section was very bland, and so they gave us some hard definitions. 1221 gains, think of those as your typical capital gains, your buying and selling stock. 1231 gains, those are going to be gains that are from sale of business assets. And then 1250 gains are going to be your real estate gains, and 1256 gains are going to be your long-term contract gains. And what you're going to see, it's very important to distinguish between the 1231 gains from the other gains, because you're going to see the rules are going to be very different. And then they also clarified that if you have a short-term capital gain that you're deferring today, when you recognize the gain in 2026, it's going to retain that same short-term character. Same thing, long-term will have long-term character in 2026 as well. Who can defer gains? They define that eligible taxpayers include individuals, C Corps, RICs, REITs, partnerships, and S Corps. So really that was kind of in line with what we expected to be allowed for the deferral elections. And then how you set up the fund, it was specified that it could be either a partnership, C Corp, or S Corp. So a lot more restriction on what type of entity can be the fund. And they also specified that pre-existing entities can be funds. Now you're going to have a challenge there because as a fund, greater than at least 90% of your assets have to be located within an opportunity zone. And what that means is not just the entities that the entity's using, but the assets that are acquired. So in order to be qualified business property, the assets have to have been acquired after December 31st, 2017. So if you have a pre-existing entity, it's going to have acquired enough assets since January 1st, 2018 to get past the 90% fixed asset test. In the code section, substantially all is used in a couple of different ways. One is the fund has to have substantially all of its assets located within an opportunity zone. For that definition, substantially all means 90%. But now underneath the fund, you have the operating business, and that operating business has to have substantially all of its assets in a opportunity zone. For that purpose, substantially all means 70%. So you have to be careful because the same term has two different definitions within this code section. But if you think about it, you could have a fund at the top level, and underneath you could have an operating business, and once you do the math there, you really only need to have 63% of your assets located within the zone. They also defined a gross income requirement that says that greater than 50% of your income generated from your business needs to be generated within the opportunity zone. They didn't give us really any detail beyond that, and what we'll see when we get to the second set of proposed regulations is now we have some safe harbor tests to determine whether or not your business qualifies. There's a substantial improvement requirement. So one of probably the most common area we've seen people use these investments is in the real estate sector. So what we've seen our clients do is they say, hey, I found this building in Detroit I want to acquire. We need to put a bunch of money into it. Is this going to qualify? And it will, provided that you meet this substantial improvement requirement. And what they came out with is they said that basically land can be excluded from that substantial improvement. So to give you a really high level example, let's say you acquire a building for $1 million and you say the land is worth $400,000 and the building's worth $600,000. For us to meet the substantial improvement requirement, we need to invest another $600,000 into the building, and it has to be spent within 30 months of our date of acquisition of the building. But being able to exclude that land, was a very common sense approach, but it's glad to, it's great to have it in writing. There's a 180-day rule. So when you recognize your capital gain, you have 180 days to invest that gain into a qualified opportunity fund to be able to make the deferral election. Now, there's two different avenues that most individuals get their gains. One is for assets that they hold directly. So, those are going to be a lot of their, direct stock investments that they sell. Or you might have some flow-through gains coming through your partnerships and your S-corps that show up to you on your K-1. So what the first set of regs came out and said is, when you have those pass-through gains on your K-1s, your clock starts on the last day of the partnership or S corporation tax year, because in theory that's when your K-1 is available to you, even though realistically you probably don't get it till much later. This was helpful in because they also gave you an election to say, well, what if I want to invest before the year end? What if I don't want to wait till I get my K-1? You can do that, but you have to make an election to have the pass-through entities date apply rather than the year end. Now, the second set of proposed regulations, when I first read through these, being the optimistic person that I am, I read through them and I said, wow, everything in here is very positive for the taxpayer. And then I started thinking about it, and there's one section that's actually very detrimental for taxpayers that people need to be aware of. So the first positive that came out of it that I had alluded to before is this gross income requirement. So what does it mean when greater than 50% of your gross income is generated from a business within an opportunity zone? Well, they gave us 3 safe harbors. And what you're going to see is the first 2 safe harbors are very bright line tests. It's going to be very easy to make that determination. The third one's a little bit more facts and circumstances driven. So the first test is if greater than 50% of your hours worked by employees are located within an opportunity zone, including independent contractors and their employees, then you're going to meet this test. Secondly, if greater than 50% of the dollar amount of wages are located within an opportunity zone, including your independent contractors. So that's going to be more or less if your highly paid employees are located within the opportunity zone, but some of the lesser paid employees are outside the zone, it's going to be helpful. And then the third test is if the tangible property used and the management team are located within an opportunity zone that generate greater than 50% of the revenue. So obviously this one's a little bit more facts and circumstances driven, but the way I kind of look at it is if your headquarters is within the opportunity zone and greater than 50% of your tangible properties in the opportunity zone, you're probably going to meet this gross income requirement. There's the original use requirement that we talked about before with substantial improvement or brand new property acquired after December 31st, 2017. But what they provided here is that your vacant buildings don't have to be substantially improved as long as they were vacant for at least 5 years. So now that $600,000 building, if it was vacant the previous 5 years, we really don't have to put anything to it. All we have to do is make it occupied and it'll qualify. Chances are you're going to have to do some level of improvement to get it in use again, but at least you don't have that hurdle that you need to surpass. And again, back to land, we talked about how land is excluded from our substantial improvement requirement, but they did come out and say that you can't just improve land in insubstantial amount. So the example that I used to always hear was, I can just acquire land and put a fence on it. No, you're going to have to meet a trade or business requirement. You have to do something. Yeah, you could buy a dirt lot and put a parking toll booth there. That would qualify because now you've created a business. But simply, putting a fence around something isn't going to make it now qualified. They provided for a working capital safe harbor. So, you put your money into the fund. What are the chances that you're really going to have it deployed in assets, by the time your testing windows come around? And so the first set of regs came out with this 31-month safe harbor that said, as long as you have a written plan in place of how you're going to spend the money, and once you get to the end of that 31-month period, you've substantially met your written plan, then that cash qualifies as a good asset. Now, this written plan doesn't have to be provided to the IRS. This, just goes in your file cabinet, but you should have a written plan in place of how you intend to spend your cash. The second set of regs expanded on that, and they allow now for an extended period if you hit government delays. And obviously in the construction industry, many of you have experienced these. And then on top of that, you have a rolling basis for your investment. So let's say you have a fund, you bring in a bunch of investors on day one, their cash has 31 months, but let's say you get 6, 12, 2 years down the road and you bring in a new investor, their cash has a new 31-month window for the spending. So it's really a rolling basis. They defined what a trader business is. And trader business is going to have the same definition as it's essentially always had. However, they did, toss a bone to the real estate investors that say that allow for our real estate entities to be considered a trader business specifically for this purpose only. However, similar to what we saw with our qualified business income deduction limitations, they did say that triple net leases will not qualify. So if you are acquiring a building, doing the rehabilitation, just make sure that when you lease it out that you're avoiding triple net lease status. And now probably the most important takeaway from all of this is in relation to the 1231 gains. As we discussed earlier, 1221 gains are our typical stock sales. Our 1231 gains are going to be our sales of business assets. And basically what they came out and said is your 1231 gains all have to be netted at the end of the year, which means that your 180-day window won't start until the last day of the year. I initially thought of, well, this is good. It gives people more time to find an investment. So you sold a bunch of business assets in January, February, March. Now you have until December 31st for your 180-day window to start. So essentially you have, call it up to a year and a half to find a qualified investment, right? I mean, that's a positive. And then additionally, since these regs came out in April, they said any of your tax year ends that end before May 1st, 2019 don't have to follow this rule. So if you had a 2018 transaction and you reinvested it too early, you're not going to be in trouble. They said, nope, you're okay. But now we'll go to the long list of cons. And one of the large negatives is if you have large 1231 losses that are going to offset your gains, you've essentially eliminated your chance to make the deferral election. And secondly, you now have to wait until December 31st. So if I have a gain in January and I have an investment that I want to make in April, May, June, I have to wait until December 31st to make that investment. And what we talked about earlier is the difference between the 15% gain and the 10% gain exclusion. To get the full 15%, you have to make your investment on the last day of 2019. Well, that's if you have a 1231 gain, that's the date that you can make your investment. So you're essentially forcing an investor's hand to make them have to actually deposit the cash on December 31st. Now, to quantify that, you're talking about a 5% difference on a capital gain. So, 5% of a 20% tax is 1% cash. To simplify, let's say I invested $100,000 into a fund. If I invest on January 1st versus December 31st, my true dollar cost is going to be $1,000. So we're not talking about, a significant difference if you are unable to make the investment on that date. But if you're going to make the investment, the greedy person in me says make the investment on December 31st to get that extra 1%. The regs don't clarify whether or not you can actually make the 1231 gain deferral at the partnership level. So as we talked about early on, you can either defer your gains at the partnership S Corp level, or you can defer it at the individual level. The regs aren't clear on whether or not these 1231 gains can be netted at the partnership level and then not pass through. It's presumed that they can, but again, it's not in writing. And now that we've seen the way they've gone with this, it's hard to advise somebody to make that deferral election at the entity level. And again, that look-through gain election isn't available on these 1231 gains because they are netted at the individual level. And one of the things that I initially thought about, going back to the previous slide where they said, well, tax year ends ending before May 1st are okay. Well, basically every 2019 calendar year taxpayer is going to have to apply these new regs. So what happened if I realized a 1231 gain in January, and then in March I reinvested it, and then in April these regulations came out and they apply to me? It really puts taxpayers in an unfair position, and quite frankly could screw people over. And then additionally, if you think about it, if your investment from 2018 needs to be made within 6 months, you head till June 28th. And then now your 1231 gains can't be invested till December 31st. You now have a 6-month blackout period where the only gains that it can be reinvested are your typical stock gains and other 1221 gains. So what I've seen is a lot of creativity in transactions where they say, well, I have a 1231 gain. I can't get it till December 31st. But we need to get moving on this project. We need to acquire this property in October, or whatever the case may be. So now you have to loan money to the fund, and then on December 31st, convert that loan into an equity interest. And quite frankly, you really have to make any sort of loan agreements, quack like a duck, so to say. And I'm a little uncertain as to how stuff like that's going to be scrutinized by the IRS, eventually when these things do get audited. Now, the second set of regs that was open for comment through July 1st, and so that comment period is closed. And I will say, looking through some of the comments that were suggested, the 1231 issue was far and away the most common thing that we've seen. Do I expect it to be corrected based on the comments? Yeah. However, until such time, you have to play with the rules that are in place. And even when they do correct it, it might be too late. It might be a year down the road. So stay tuned. Hopefully, it's something that they correct sooner rather than later. But we're getting close to year end, and any correction is not going to be helpful for 2019, once our returns are filed. So what can UHY do to help? Any compliance work in relation to QOF elections, helping to set up the fund, helping identify gains, and working really with your tax advisors in conjunction with your financial advisors to make the best investment for you. There's some links for some interactive maps. Really, if you just go on Google and type in Opportunity Zone Interactive Map, there's tons of links. But it's interesting when you look at them and you can really see, the first link, for example, it's all orange, and you just see Metro Detroit has a large orange area around it, and there's, all over the country. People often ask me too, well, this isn't in a zone, is it going to be? No. If the zones were already designated, if it's not an opportunity zone now, it's not going to be 6 months from now, so no need to check back later. But really interesting. And I'll open it up for any questions.
So, John, I was blown away when I clicked on that map to see where those zones are, because they really are not. I thought it would be really, really distressed areas that, do I really want to invest in that? But that's really not the case. Isn't that what you found?
Yeah, actually, our Sterling Heights office is in an opportunity zone, believe it or not. So
There you go. So that's Hall Road and Van Dyke. And then, so let me ask you this. If there is a capital gain that somebody is looking to invest for 2019, you're still going to get that maximum deferral if you hold it for the, or exclusion if you hold it for the 15 or the 10 years. Is that true?
yes.
Can you kind of highlight that a little bit more? Because I think that's a big deal, and I think people need to know about that, how it's a permanent exclusion from
Yeah,
tax.
so I think the easiest way to illustrate his question is with an example. Let's say I have a $1 million capital gain today, and I invest it, by December 31st, 2019. In 2026, you're going to pay tax on 85% of that, or you're going to pay the tax on $850,000. But now you hold that investment for at least 10 years, and you sell it, 12, 15, 20 years from now, and you sell it for $10 million. Well, you just realized the $9 million gain. That gain is permanently excluded. You never pay tax on that. As long as you hold your investment for 10 years, the only gain you'll ever pay in relation to this investment is on that 85% that you're excluding today. Yes.
Let me get you a mic.
A question for you, John. If you have a client that has a large gain, are there opportunity funds already out there so that they don't have to go out and set one up themselves? And if so, how do they find these particular funds?
Yeah, and there really are two different approaches to this, and what can you do between now and year end? Step one is identify if you have gains. If you have business gains, chances are you probably are already aware of them. You've either closed the transaction already, or you're in the process of closing it, since we have less than a month and a half left. Secondly, you might have some deferred gains that are sitting in a brokerage account that you could trigger. So then the question is, what do I do with those gains? You can either find your own investment, which that's what we see a lot of with our clients, and that's why we see a lot of real estate, is because they identify a building and then they're like, okay, well, let's set up the fund, let's acquire the building and go that route. Now, the other side of it, to Dennis's question, is what if I just know I have a gain, but I don't really want to, find my own fund? There are a lot of funds out there. Goldman Sachs, Morgan Stanley, they have funds that they're actively soliciting. So if you have a financial advisor, they can certainly speak to, the quality of the investments, or help you advise on that. I mean, it's really the sort of thing that you should be working with, both your CPA and your financial advisor together to make sure that you're doing everything correctly. But I had actually done a panel with a couple fund managers, and one was a fund out in Arizona, and one was a fund in California. And it was interesting to hear, what their strategies are. But basically, those managers, they were just syndicating. They were just looking for, wealthy people with capital gains they wanted to defer. And, they had different investment options. Some of them were looking for, investments as low as $100,000, some $250,000, really, and as high as you could go. But their investment strategies were very different. One was investing in airport parking lots because most airports are in qualified opportunity zones. The other one was identifying city blocks in large cities to be able to say, okay, I want to buy up this block, put in a Whole Foods or something, and then an apartment building. So there are a lot of those funds out there if you look. Thank you.
All right, so our next topic is kind of a technical one, but I asked Haley to really make it, bring it down to a level that we can all relate to. I see bankers in the room, I see bonding agents in the room, I see business owners in the room. So we all need to understand what's going to be going on and happening, because it's going to be a change to your financial statement. All three of those people, banks, bonding agents, and business owners, is going to need to know how that affects their statement. At the end of the day, the construction industry is very unique. For 30 years, we've been doing a cost-to-cost method, right, to calculate what our income is and then our WIP. That's different than a lot of other industries. So when they've issued this revenue recognition, a lot of other industries are really panicking because it's a new way to look at things. But in the construction industry, we've already been looking at it in this regard. So while you have to go through the exercise and you have to get an understanding of this revenue recognition, at the end of the day, I'm not predicting that there's going to be that big of a change in somebody's individual financial statement. But it's something that needs to be addressed, something that people need to understand, because when a banker gets your financial statement or a bonding company, there are going to be some differences, and they're going to want to be able to understand what that difference is. So, Haley, come on up.
Awesome. Thank you. Can everybody hear me? Good? Awesome. Whoa, okay. So, like John said, the new revenue recognition standard that's coming out, I feel like it's been kind of dwindling there ever since, this is going to tell my age right now, but ever since I was in college. So on top of that, leases has been hovering there as well. So today, like John said, it's a very technical aspect of what we're doing. So I'm going to go over high level. Hopefully by now, each and every one of you out there have had the opportunity to actually go in front of a UHY representative or some other CPA out there to at least get a general background. So with that, I broke it.
This one's the forward.
Perfect. Yeah, the big green button, right? All right. So with that, the agenda today. So first topic is going to be the revenue recognition standard. We're going to go over the effective dates, the implementation methods. Obviously, those of you out there have hopefully by now looked through the 5 steps that they've broken it down into. And then we're also going to talk about other considerations, and then we're also going to discuss what we've identified at UHY, given some of the background that we've had on our existing clients. And then followed up with the lease standard, we'll go over the effective dates and the implementation methods. We'll also go over lease overview, lease classification, effect on the construction industry, practical expedience, and then any updates to both of these guidances. So first up, revenue recognition. Effective dates. Public companies have already implemented this, and I will let you know, me and John were able to go to the AICPA conference last year, and they had many issues in public accounting that actually resulted in many updates throughout 2018 relating to the implementation. So we are lucky enough being in the private industry where we can learn from that. So it allows us a little more time to see what they're working out tweak-wise and hopefully applying it going forward. And then obviously private companies, 2019 is the year. So this is a nice representation of the 2 methods that you can implement and hopefully you have actually looked into this guidance and thought, hey, are we going to do a full retrospective or are we going to do a modified retrospective? Now, the full retrospective, you're going to have to go back and you're going to have to adjust every prior period that is on your financial statements. We are strongly suggesting not to do this, so get in front of your bank, discuss with them, make sure that it's appropriate to use the modified retrospective. The modified retrospective is allowing you to adjust the 1/1/19 retained earnings for any adjustments that are going to be posted. Like John said, we don't think there's going to be a lot of modifications, but there are some one-offs that I don't think a lot of industries have really looked into because it's just been general practice. So here's an overview of the steps. Step 1, obviously identify the contract with your customer. Step 2, identify the performance obligation in the contract. Step 3, determine the transaction price. Step 4, allocate the transaction price to the performance obligation. And then step 5, recognize revenue when or as performance obligations are satisfied. So, step 1, just a general overview, definition of a contract. I know it seems very basic, but if you actually look at the guidance itself, some of the items you consider a contract actually are not a contract, so they will actually not be applied under this standard. So that's something you really want to, take a good look at. So contracts can be written, they can be verbal, or they can be implied. It does not exist if both parties have not performed and can cancel without penalty. And I think that's the biggest part of this is that second bullet point right there. And then enforceable rights and obligations in the contract. Now, within this step, there's also other factors. There's 4 different criteria that you want to make sure that the contracts meet. For time purposes, I'm not going to go through those, but if you want to have a follow-up with that, I'd be more than happy to talk and discuss with you all that. And then also contract modifications, any change within the scope and or price of a contract, change orders, claims basically. And then also you want to consider combining contracts. Sometimes if contracts are, if they're agreed upon close to each other, you can essentially bundle them. Obviously there's certain criteria for that as well, but of course given the time, unfortunately the guidance itself is very, very technical, so that would be on a contract by contract basis. Next up, there we go. Next up is step 2, identify the performance obligations in the contract. So you want to identify the goods or services are distinct. Distinct has its own definition. So distinct obviously is, are you able to identify this as a separate performance obligation itself? Distinct is used quite often throughout the guidance itself. So just make sure you have a good understanding of that word. So there's actually 2 steps. Step 1 is a good or service capable of being distinct. So basically what that means is can you benefit from the individual good or service on its own or together with other resources that are readily available to the customer. And then there's a step 2, which is good or service distinct in context of the contract. And the good or service is not integrated with, highly independent on, highly interrelated with, or significantly modifying or customizing other promised goods or services within the contract. I know it's a mouthful, so like I said, always refer to the guidance. I know myself, I have the guidance printed out, and each contract that I go through, I actually go through each step. So I focus on the first step, I make sure I go through all of that, make sure all of the guidance that is within the contract I'm reading correlates with the guidance that we have in the revenue recognition standard, and then I move on to the next one. Other factors that should be considered are series, which are, do they have the same pattern of transfer if both of the following criteria are met. Each good or service in the series that promised to transfer would meet obligation satisfaction over time, and also some method of progress towards satisfaction of the obligation. And then I think the biggest one that will affect the construction industry is contracts completed in phases. I know some contracts include fabrication services and erection services together. What you really need to do is take a deep dive, and if those are distinct, you need to determine whether those should be separate performance obligations or if you can still keep those together into one contract. Next up, step 3. I'm going to emphasize step 3. Step 3 is probably the step where most of you will be affected. Step 3 includes variable considerations. Variable considerations, it's a wide range of items. That in itself could probably have its own PowerPoint. So for time purposes, I'm only going to focus on the high-level ones that will probably more than likely affect the construction industry. Also, you need to take into consideration significant financing, non-cash considerations, and consideration payable to the customer. So with the variable consideration, one word that always pops up is it constrained? And basically what that means is that you can only recognize revenue up to the probable amount that you're going to be able to actually recognize, essentially. So, you know, if you have a $500,000 contract, but realistically you're only going to recognize $250,000 of that, you can only recognize $250,000 of that based off of the estimate and the constraint that's been put on that revenue. Another component is the significant financing aspect. Now these apply to advance payments before a contract that you may receive from a customer, or this may even be the financing that you have to do because part of the contract terms specifically states that you're not going to get any payment until after the contract is complete. So you have to take this in consideration. There's actually quite a few pages on significant financing, so make sure you focus on that as well. Non-cash considerations. Any non-cash considerations are just measured at fair value, so make sure you're taking that into account. And then consideration payments made to customers, make sure these are reducing the transaction price. I mean, if you have to pay the customer back for part of the contract, make sure you're reducing the contract for that. And then, so measurement, we have two ways to measure this, and this mostly goes towards the variable consideration aspect. So you have the expected value, which is the sum of the probability weighted amounts in a range of possible considerations. To be honest, we want to apply this method towards large number of contracts with similar characteristics. You don't want to do ones that are highly variable. It'll be more of a headache for you than applying the most likely method. So the most likely method is just a single most likely amount in a range of considerations. So whatever you have come to the conclusion of would be your estimate on the most likely amount. And like I said, step 3 is huge. Here are some just variable consideration examples that we've identified. Some contracts have performance bonuses. Some contracts have obviously unapproved change orders, which I believe a few of my clients personally have been affected by, so we've had to adjust for that. We have price concessions. You have payment and volume discounts. You have rebates, pricing based on an index or a formula, liquidated damages, and then awards and incentive fees. I will go into detail a little bit later on approved change orders and the liquidated damages. Those are two high-level areas that we've identified within contracts with our clients now that we've had to actually dive into and take a deeper look at. Step 4, allocate the transaction price to the performance obligation. So allocation is based on observable standalone selling price. Essentially, hey, this is the product that we're selling, this is our selling price, this is what we're going to put it as our contract value as. If it's not observable, estimation is required, and there's 3 different methods that you can apply to that estimation. You have the adjusted market assessment approach, you have the expected cost plus margin approach, and then you have the residual approach. I'll let you know now, residual approach is only going to be used in rare circumstances, so I would focus more on the other 2. And those, like everything else in the revenue recognition, has a lot of standard and guidance on it. So if you want to dive deeper into that, I would highly suggest talking to your CPA or UHY representative and making sure that you fully comprehend every aspect of these 3 methods. So the standalone selling price used to perform the initial allocation should not be updated after contract inception. That's a big thing that they highlighted multiple times throughout the guidance. So I just want to emphasize that point and make sure that everybody in the room at least is aware of that. And then if there's no performance obligation, you just simply skip this step. Last part, step 5, probably one of the easiest steps out of all of them, is just how you're going to recognize revenue. You're going to recognize it basically over time or at a point in time. Now, this visual representation that I have up here today, this is just a nice general overview of basically, hey, if they fall within the 3 criteria of these items, they're going to be recognized over time. If not, as you can see in gray there, they're going to meet a transfer at a point in time. So considering we're in the construction industry, I'm assuming at least 95% of the contracts are going to fall under overtime. And then, so satisfaction over time, there's output methods. So, output methods are basically direct methods that you can apply towards recognizing. So you have the surveys of work performed, your units produced, units delivered, or contract milestones. I know a lot of individuals use the contract milestones. That's when they're able to bill out and actually recognize the revenue for work performed. There's also the input method. So it's the entity's efforts to satisfy the obligation over the life of the contract. This, costs incurred, labor hours expended, machine hours used, time lapsed, and quantities of materials. Obviously, like I said, most of those in the room probably use contract milestones. So, also we have contract costs. So, costs to obtain a contract. Basically, what falls under this is incremental costs to obtain. So an example of this would be sales commission. Some contracts have sales commission within the contracts themselves. If you do have contracts with this, I would highly suggest looking into this. They must be recoverable, and you can capitalize and amortize those over the life of the contract. There's also a 1-year expedient that can be elected. So if the contract is less than 1 year, you can actually end up expensing these costs instead of having to capitalize them. And then the next one would be cost to fulfill. So basically this is anything to generate or enhance the internal resources. These must be recoverable. You must capitalize and amortize over the life. There is no expedient for this one. So this would be costs that relate directly to the contract, and if certain criteria within this guidance is not met, you can actually expense it. Like I said, there's no expedient, but if the criteria under this is not met, then you can expense those items. So I highly suggest looking at those guidance within the ASU itself. Another big topic with this ASU is principal versus agent. We have subcontractors. I know, clients out there, you own the contract, you subcontract it out, or you're just a subcontractor of a bigger project. So, you mostly need to consider this, obviously, when it comes to subcontracting, but the principal criteria that you need to look into is who bears the primary responsibility for fulfillment of the contract? Is it you, or is it the other individual that you're working with? You also have to take into consideration any inventory risk. Are you the one that are going to bear the losses if this job goes sideways? And then latitude in establishing prices. Are you the one that controls the prices passed off to other individuals that are working within that contract? And then, of course, once you've done your assessment, are you going to record it gross if you're the principal agent or the principal, and you're going to record it net if you're the agent? So other considerations, there's a whole chapter on this. Lost contracts is one of them. And with lost contracts, you want to test at the contract level, kind of what we already do through Legacy Gap. And then you can also elect to do this at a performance level based on the contract. Warranties, I know a lot of contracts have warranties in there for work performed. But realistically, given what we learned at the AICPA conference, a lot of construction contractors, they fulfill these warranties as part of contract fulfillment. So unless it's more of a wear and tear type of warranty that can be offered outside of the contract itself, realistically, warranties aren't going to be something that you want to look into too in depth. So just keep that in mind. You may have, like I said, you may have a warranty in there, but realistically, if it's not for wear and tear outside of the actual fulfillment, then it's something that you probably don't need to consider. License of intellectual property. For this, you want to determine if these licenses are distinct in nature, and if so, you want to determine, is it a right to use, which means you're going to recognize that at a point in time, or is it a right to access, which you'll recognize over time. If no, then account as a bundle and recognize if once it satisfies the combined obligation of the contract. Bill and hold transactions. You want to take into consideration of transfer of control needed for bill and hold transactions, non-refundable deposits, not recognized unless it relates to the satisfaction of the obligation. So just keep that in mind. If it doesn't directly correlate with the contract itself and satisfying that contract, realistically, you shouldn't be recognizing it. And then I know this was a big topic last year, and it's probably still a big topic this year, but uninstalled materials. I'm actually going to go over that in depth in my next slide. It's one of the big things that we identified within our existing clients. So, of course, it's going to be the first topic. I'm sure some of you out there have been affected with uninstalled materials, and I know it was a big topic last year. It's been a big topic basically ever since the standard has been established. So uninstalled materials, you need to exclude these from the measurement of progress towards fulfillment of the contract performance. So you don't want to add this to your WIP schedule, essentially, is what it's saying. And the reason for that is because it's gonna overinflate the revenue recognized. And obviously, you know, us being GAAP professionals here, we don't want that. It's red flags from the get-go for us. So what we suggest doing is you have to establish who has control of those inventory items. So does the customer have control, or do you have control? So, and the reason I say that is because control is a huge thing. Control, basically, there's 3 questions you can ask yourself to see if you yourself have established control or if the customer has control. So has the owner been billed and paid for the material already? If you as the contractor were fired today, who owns that material? Would it be you, or would it have to go to the customer? And then if you as the contractor unfortunately had to file for bankruptcy, who would own that material and who would essentially have to settle that? So with that, say the owner has control. If the owner has control, what will end up happening is you can recognize revenue up to the cost of that material on your WIP schedule. If not, then you're going to have to put that, if you have control yourself, you're going to have to label that as inventory on your balance sheet. I know a lot of times people just put that as costs incurred on the job to date, but unfortunately that is not the right way. And the reason I say that is because, like I said, it'll overstate revenues. And just as an example, actually have a brief example. So under existing GAAP right now, say you have a $2 million contract. You're expecting about a $200K gross profit, and due to the costs incurred, which are about $300, which we're gonna assume $200 of that is uninstalled materials, you've recognized revenue of $333,000, which is showing a percent complete of about 17% at this point. Well, under the new GAAP, what you need to do is you kind of need to break that out separately. So new GAAP, you're going to recognize $1.8 million of revenue on that $2 million contract, and you're going to break it out into $200K of a separate contract itself. And then from there, you're going to recognize $100K of costs, because that's actually costs incurred on the job, against the $1.8 million. So realistically, your job's only going to be showing about a 6% completion rate. And then below that, for the uninstalled materials, you're going to have the $200K, but you're also going to recognize $200K in costs. So essentially, your gross profit's zero. You're not recognizing any gross profit for that, and it's showing as 100% complete. Now, it may not seem like much, but just given this example, the difference in revenue recognized would be about $21,000. And so if you spread that across all of the contracts on your WIP schedule that have this instance in it, it could end up being a very material discrepancy, essentially. And now this example itself is recognizing $21,000 more than what you should be. So overstatement of revenue recognition is going to be a huge thing this year. I will let everyone know now that has to have an audit. We are greatly improving our revenue recognition testing. So I apologize now for any headaches that we may cause you down the road, as I'm sure they are going to be significant headaches. So next up would be unapproved change orders. So unapproved change orders, I think, it's a little more easier to assess. Essentially, you're supposed to assess and estimate the probable amount that you're going to be recognizing on unapproved change orders at year end. So realistically, if you're in the final stages of an unapproved change order and you've already got verbal approval that they're gonna give you $100,000 out of the $200K that you gave them for the change order, then you can recognize that $100,000 and leave the other $100K off the books. Abnormal costs is another one, wasted or spoiled materials, unproductive labor from delays or changes in scope. Essentially, these should be expensed as incurred. Some people, unfortunately, were capitalizing this, which is not true. So it overinflates revenue once again, which is a big red flag for us. Liquidated damages. Like I mentioned earlier, this is actually a bigger issue that we've come across. Liquidated damages for penalties as far as not completing the job on a timely basis. And I think one thing we were able to pinpoint is in the city of Detroit, if you have a contract over $3 million and 51% or more of your workforce labor is not Detroit bona fide residents, then you're going to get hit with a penalty. Now that itself qualifies under liquidated damages, and that needs to be assessed on a contract by contract basis. So I know, Detroit's up and coming, it's booming. There's lots and lots of contracts out there right now. So if you have a contract that's based in Detroit, I would highly suggest looking into those and realistically seeing how material that is going to be on your WIP schedule as a whole. And then, of course, separate performance obligations. Like I mentioned earlier, those of you who have contracts in phases, you want to make sure that you're properly assessing, hey, should these truly be together in one contract, or should we be separating these into two separate contracts and recognizing revenue that way? So just disclosure changes. There's going to be in Note 1 for Topic 606 additional wording, essentially. So the additional wording is just it's gonna beef up how you're going to be recognizing revenue. It's going to be talking about different contracts, if they're fixed prices, unit priced. So you're going to see those come across. We're actually in the process of finalizing our general disclosures internally. So hopefully within December or even early next year, we can at least give each and every one of you a template that you can read through and make sure it's in compliance with what you want to give to the bank. And then on the balance sheet, one big change, cost in excess. They're now going to be called contract assets. And then billings in excess are now going to be called contract liabilities. And then one big thing I want to point out is if you have incremental costs that you end up capitalizing, you can't just lump that in with the contract assets. You have to separately identify that on the balance sheet as well. So say you have contract assets and incremental costs, you're going to have contract assets, other contract assets on the balance sheet. All right. Another huge topic, which I think once we all heard that it was extended, we just kind of took a nice little breath of fresh air at that point, given that the revenue recognition has already been a headache for most of us. So the good thing with the lease ASU is that it was amended in October of 19 to extend the effective date starting after December 15th of 2020. So essentially it won't be effective until 2021. Now the only implementation method for leases is going to be the modified retrospective approach. And there's practical expedience for this. That's why the modified retrospective approach is going to be the form that you have to use. So just a general overview. Lease definition: contract conveys the right to control and use of identified property, plant, and equipment for a period of time in exchange for consideration. There are exclusions. There's intangible assets, the explore or use of non-regenerative resources, biological assets, inventory, and then, of course, assets under construction. Now, these are 4 different ways you can measure the lease term. Essentially, it's any non-cancelable period, any periods covered by an option to extend the lease if the leasee is reasonably certain to exercise that option. So, hey, is there an option within your lease that says that you can extend it? Are you going to extend it? More than likely, then you should recognize that. Periods covered by an option to terminate the lease if the leasee is reasonably certain not to exercise that option. Say you have the option, but you choose not to, you're going to terminate it once it expires, then you're only going to recognize that period. And then periods covered by an option to extend or not terminate the lease in which the exercise of the option is controlled by the lessor. Now, some criteria that fall under this for reassessment of the lease and purchase options. So basically for this, any significant event that takes place that changes the circumstances of the lease, you're going to have to reevaluate. So basically for this, any change in circumstance is, as an example, say they added an additional building to your lease that would require the lease rent to go up. Rental expense increases due to the additional rental of an addition to a building would cause an event for you to have to reevaluate. Any contractual event that takes place, so anything actually clearly written in your existing contract that you have to do would be an event they would need to reassess. And then the option to exercise and then the option not to exercise, like I mentioned before. So one nice thing that they have is for short-term leases. So election can be made for any short-term leases. Essentially, this is any lease that's 12 months or less with no option to purchase the asset because that qualifies under a finance lease. So obviously that itself would be capitalized. Will not recognize a right-of-use asset or liability and recognize lease payments as expense on a straight-line basis. And I want to emphasize straight-line basis. Unfortunately, any of you out there that are actually lessors, there is no exception that can be made for these. Now, just as a quick example, say you have a 9-month lease, but there's an option within the lease to extend it for 4 months, which essentially puts it up to 13 months, which is over the 12-month period. Well, if you choose to exercise that option to extend, it will not qualify under the short-term lease. But if you, from the get-go, choose that you're not going to extend it, say you're just in a location for maybe 8 months and you have a 9-month rental, then realistically you can show it as a short-term lease and it'll fall under this guideline. So quick overview, just lease classification, finance lease, transfer of ownership at the end of the lease, which that's already been there. Option to purchase the asset and expect to exercise that option. Are you going to buy it at the end of the lease? And then lease term for a major part of the economic life. Now that step itself is very vague. So the guidance basically says that 75% or more of the economic life of that lease, if you are going to be in ownership of it during that time, then more than likely it's going to fall under this criteria. Now, there is one guidance that you want to look into. If you end up renting, say, a used piece of equipment, you want to assess and determine whether it's at 25% or less of its economic life. And if so, then it actually does not fall under these guidelines. So that's one thing you want to look out for when you're going through your contracts. Just making sure, hey, if it's new, then obviously more than likely it's going to fall under this. But if it's used, you want to make an assessment on its remaining economic life. And then also the present value of lease payments. And then there's no alternative use to the lessor. If it doesn't fall under these criteria, which I believe 95% of the leases going forward are going to, it's going to be an operating lease. So this is just a nice little breakout of how under each method a lease would be accounted for. So you would have a lease liability of $38,000. Your right to use asset under a finance lease would be $38,000, and then under operating lease, $38,000. I mean, it's the same on that end. It's just how you're going to be recognizing it subsequently. So essentially in year one, the biggest difference would be the interest expense and the amortization expense. As you can tell, just between the total lease expense recognized on the finance lease compared to the operating lease, it's a little bit higher, but essentially you end up with the same endpoint. So effect on the construction industry. Lease construction equipment and vehicles. Every job requires certain machinery and equipment that should be used on that, and obviously machinery and equipment is fairly expensive and you don't know if you're going to need it for jobs going forward, so leasing is the more reasonable option. Changes to the financial ratios, bonding companies and banks. I know this is something we've been wondering about ourselves. How are banks going to consider these? Based off of the construction conference that we went to last year, they're still in the process of determining this themselves. And then also complicate lease approval process, and then related party leases. I know a lot of us have related party leases out there, so that's definitely something that we want to take a good look at. Now, one good thing is there is actually a practical expedient that you're allowed to take. Now, basically, the practical expedient is for existing or expired leases. This is what allows us not to have to do the full retrospective approach. So the following can be elected by an entity separately or in any combination. So there's 3 bullet points under this. The first bullet point, entity can elect to apply a package that allows it to not reassess, essentially whether the contracts are or contain leases, lease classification, and whether initial direct costs qualify for capitalization. Now you have to elect all 3 of these together as a package. Next up would be the entity can make an election for all existing leases to use hindsight when determining lease term and assessing impairment on the right of use assets. And then the following, their last one is the entity can make an election to continue applying current accounting policy for all land easements that exist or expire before the accounting standard applies. Now, just a word of mouth here, but this does not exclude any incorrect assessments that you have existing currently. So just because you didn't do it under this standard and it's been existing doesn't mean that you can do the same with the new standard. You're going to have to make a full assessment on any incorrect assessments. And then also, this doesn't excuse failure of no assessment done at all. So last, basically this is just the updates that have taken place since this guidance or these 2 ASUs have been out there. Leases, 2018, basically the end of last year, there was a new amendment out there that sales taxes and other similar taxes collected from lessees that it affected. Certain leaser costs were redefined, and then recognition of variable payments for contracts with lease and non-lease components. And then in March of this year, there's just general codification improvements. Now, revenue recognition, there's been 8 amendments since 2014. The most recent was in 18, relates to the classification of topic 606 with topic 808. Essentially, it's the collaborative arrangement. It's just collaborative arrangements were not included in the original guidance, so it's just kind of closing that gap in between those 2. I'll let you know now, one of the revenue amendments was for the deferral period to extend it. 5 of them have been technical updates, 2 which relate to SEC clients, and then 2 are just general guidance updates. All right, so, oh yeah. Are there any questions out there? I know this was a lot of technical. Like I said, hopefully your UHY representative has been able to get in front of you prior to this. This was more just a general overview of everything.
So I know that the standard's been pushed.
Yes.
But can you just reiterate for everybody when that actually comes into place so we can get in their mind and start thinking about it?
Yes, so 2021 will be the implementation year. I will let you know now, we already internally have decided that next summer, just like revenue recognition this summer, we're going to hit it hard. And also actually internally, we have been looking into softwares where you can just input all of the lease information and it'll spit out exactly what you need to put on your balance sheet.
You mentioned earlier on that the standard might not apply to contracts that can be canceled without penalty. Did you have feedback on contracts that have a termination for convenience provision and how that may or may not apply? Like pretty much every contract.
Yeah.
We see as that.
Yeah, so like I said, technically verbal contracts apply under a contract, but verbal contracts, I mean, if you think about it, verbal contracts, there are no termination clause. There's nothing written. There's nothing there. So it mostly, unfortunately, what I've seen only applies to verbal contracts. So written contracts, I mean, it's something that's signed. It's there. It's noticed. So mostly it's just what I've seen verbal. I haven't really seen many not qualify under that. Anything else? Perfect. Thanks.
All right, so just to kind of give you an update, we're going to do one more session, tax session with me. And then we're going to take a break so people can stretch their legs, get refreshment, whatever. We're going to come back, and then we have some outside speakers, non-UHY speakers that are going to be, can't wait to hear what they have to say. They have some great information for you. So with that, let's start with the tax update. So kind of where we've been, there was the last major reform to the IRS code was back in 1986. So it's been 30 years that they gave me to learn all the rules of the tax code. And then in 2017, they go and change it, and they expect me to learn all these new rules in 1 year. What's up with that, right? There was some major changes that started in 17. Some of them actually were implemented in 17, but most of them hit in 18. So we had all of 18 to kind of get our hands around all these different changes. So now that we've done that, we've had a year under our belt, we have a better understanding of how all of these things tie together. So just a quick refresher, some of the things that are new with the new Tax Act that came into play in 18 and still apply for 19 is there was 7 new tax brackets with new tax rates, and that was a good thing. I'll give it a thumbs up. They eliminated the federal personal exemptions, so your kids and that you claim as dependents. So I'm going to give that one a thumbs down. They nearly doubled the standard deduction, which is fantastic. Another thumbs up. The one that went over like a lead balloon was they limited in your itemized deductions that you can only deduct state and local taxes, like property taxes, real estate taxes, to a maximum of $10,000. That's a way big thumbs down. All our clients, no one's happy with that one, for sure. And then they doubled the child tax credit, thumbs up. A couple other ones were they reduced the amount of mortgage interest deduction that you can take, so they lowered it, thumbs down. But then what they did was they changed the amount of charitable contributions you can take on your personal return. So it used to be 50%, they bumped it to 60% of what your AGI is to incentivize people to give away charitable contributions, thumbs up. So the next one, kind of an oddball one. So alimony payments that are paid, the payer does not get a deduction, thumbs down, but the payee who's getting that income doesn't have to pick it up as income, thumbs up. So that one kind of goes both ways, right? And then there was a substantial increase in the estate tax exemption, so that's a very big thumbs up. So as I discussed before, here are those 7 tax rates with a pretty decent rate, top rate of 37%. Previously you could be way into the 40% tax brackets, 37% for individual. These rates are married filing joint. It's pretty decent. As I mentioned, the standard deduction was $24,000. For 2019, it goes to $24,400. And what that did was that eliminated for millions of taxpayers the need to itemize their deductions. So previously, that standard deduction amount was around 13 grand. So a lot of people were scrambling to get enough charitable contributions, and get enough expenses to beat that 13 grand. And a lot of times people did. They had 14 or 15,000, so it was a benefit to them. Well, now by raising that number to 24,400, many, like literally millions of taxpayers will never hit that threshold. So they don't have to be, pulling out those receipts, looking through all that. It doesn't apply because you're never going to hit that threshold. So that really did simplify tax returns for a majority of the people in the country. And then, as we talked about, the federal exemptions for individuals, dependents, was removed. So just a quick hit list of some key facts. The top rate is 37%. That's on income that's for 2019 above $612,000. We have a very favorable qualified dividend rate of 20%. That's great. And then the last two items were actually implemented, and I'll call them Obamacare taxes, when Obamacare was put into place. So the first one is a net investment tax, and that is an additional 3.8% on interest, dividends, capital gains if you have EGIs over $250,000. The second one is a medical health and insurance tax, which is an additional payroll tax of 0.9%, which effectively takes your Social Security rate from 1.45 to 2.35, and that's if you have AGIs over 250 as well. So this chart is a very interesting chart. It shows the maximum Social Security wage over the last 50 years. But when I looked at this chart, the one thing that I said was, well, how do they determine that number, that maximum wage where it cuts off and you don't have to pay into Social Security anymore? So when I looked into it, they had readjusted the base year to be 1994, and at that time it was $60,600, and then every year after that there's an index factor that's applied to that amount. So in 2019, that maximum where you still pay Social Security, you paid it all the way up to $132,900. In 2020, they adjusted that factor, and it's now $137,700. So effectively, you're going to pay, if you hit that number, $8,534 in Social Security. Now, Medicare portion of your check is unlimited, so that never stops, and that's calculated on all your wages. So you can see from 18 to 19, the increase was 3.5%, and then they it was basically the same kind of increase, 3.6%. One of the funny things is when my son first started working, he was very excited to get his first check for the 7 hours that he worked at Jet's Pizza. So he was calculating his tax rate, or the amount he got paid per hour times his 7 hours. He got his check stub, and he said, "Dad, who's this FICA guy, and why is he taking my money?" And I said, "Son, he will not be the only guy looking to take your money as you go in your lifetime. So just deal with it." But it was pretty funny. The estate tax exemption, which was a big thumbs up, they actually increased that to over $11 million. So for 2019, that amount is now $11,400,000 per individual. As you can imagine, though, all the Democrats that are talking right now, they're looking to knock that down. So, one of the big aspects that you have to really watch moving into the this upcoming year with the election is what they're talking about and where they think they're going to take that estate tax number. So I guess my point to that is plan your death accordingly. Watch that closely. You want to make sure you take advantage of that $11 million. One of the things that was appealed or removed that was in Obamacare was if you did not have health insurance, you actually had to self-assess, check a box, and pay a penalty of $975. That was removed with the Tax Cut Jobs Act. So some tax tips on an individual basis, now that we're getting close to the year end. Really taxes are not that sophisticated. The basic thing that everybody probably already knows, because we've said it a million times, is defer, defer, defer. Why pay $1 of tax today when you can defer it to another year, and who knows what's going to happen? That's not really the case anymore. It makes it very complicated to determine what to do. Because right now, we're really at some historical low tax rates for both individuals and companies. And depending on what happens next year, I'm going to say that over and over, where are those rates going to go? So, maybe the play is to enjoy these low tax rates and pay the tax now versus deferring it, because the rate might be even higher in the upcoming years. So that makes it really, really difficult at our end to advise and help plan. But typically, one of the things you want to do is, if you're not meeting those thresholds for the standard deduction, bunching up expenses, pulling expenses in early, deferring, revenue to a later period. But again, I would suggest talking to your tax advisor, because maybe that's not the best play. It's in all the newspapers. It's in every article that you ever read is, United States individuals don't save enough. They don't have enough. So I can't stress enough, put away in not only 529 plans, which are educational savings plans for your kids, but make sure you're maximizing out your 401k. You're maximizing an IRA. Put away as much as you possibly can in these tax-deferred vehicles, because it's just everywhere that you look, it's people don't have enough saved. One of the other things is credits. Credits are different than deductions. A deduction reduces down income, but then you still apply a tax rate, where credit is more of a dollar for dollar type tax reduction. So don't let those credits go to waste. If you've been phased out because your income's too high, because you have a child in college and you're getting an educational credit, but you don't necessarily qualify, check with your son or daughter, because they might qualify, and you don't want to throw that credit away. I mean, that's free money. And one of the big things that we've had recently is, a lot of my clients have come to me and said, John, I really want to be charitable, but I don't know where to put my money. But I want to get a deduction for it. So one of the key planning tools you can do right now when you talk to your advisors, because right now's the time, is to say, I have this excess cash. How do I get a deduction for it? How do I get a charitable deduction? But I don't know where I want to place that money. I don't know who I want to give that money to. You can set up a donor advised fund, and you can put a big lump sum dollar amount in that fund. Now, once you put the money in, it's gone. You can't take that back. But what it allows you to do is take a very large charitable deduction in the current year, but then next year or whenever, you can determine who you want to give that money to and what charitable organization you want to donate it to. So it takes the pressure off of, man, I got to get rid of this money, but I don't know who I should be giving it to, or something of that nature. So those donor advised funds are a great vehicle to be able to do that. So now we'll get into some business items. And I love this graphic. Does that guy on the left, he looks like a martini drinker, doesn't he? With his jacket and tie. I can see him sitting somewhere at 3 o'clock with a martini in his hand. So in the same vein, some of the changes that happened to businesses was the C Corp corporate tax rate was dropped to a historical low 21%. That's good. That's a thumbs up. There was changes to the expensing of property and equipment, which is always a big deal for construction companies, either through bonus or Section 179. Both good, thumbs up. And they eliminated the alternative minimum tax for C Corps. So that's another good thumbs up. So definitely pro-business here. One of the things that is a big thumbs down was they got rid of the deduction for entertainment. So typically, when you go to a ball game, you're taking a client, you're paying for the tickets, you're buying some food, you're buying some drinks, you're having a good time, you get to deduct at least half of that. Well, now that entertainment piece, those tickets are non-deductible. So you tell me, taking a client to sit through a 3-hour Tigers baseball game, that's not entertainment, that's work. Why aren't you getting a deduction for that, right? I don't get it. Another thing that they changed was the net operating loss rules. So previously, your company's chugging along, you had income, you paid some tax, you had income, you paid some tax, now all of a sudden you hit a bump in the road and you have a loss. So if you have a loss, you probably have cash flow issues. So previously what you were allowed to do was you could take that loss, carry it back 2 years, amend your return, and generate some cash flow to help your business. Seems pretty fair. If you had excess loss, then you could carry it forward for 20 years. Well, now they changed that rule to say you can't carry a loss back. Oh, and you were allowed to offset 100% of that previous income, 100%. Now you have to carry that loss forward. You're only allowed to use 80% of that loss, so there's still going to be 20% that you have to pay a tax on. So when they say we eliminated that alternative minimum tax, they really haven't, because they're implementing other ways where you're still going to pay a minimum amount of tax. And then the last two were probably the two biggest changes to the code for businesses. And while they seemed really great and they seemed pretty easy, once we got into them in 2018, we found they were very challenging and complicated to calculate. So the first one is Code Section 199A, Qualified Business Income Deduction. So if you know tax guys and tax geeks, and we have a lot of them at UHY, they love the tax code and they love code sections. They like to spit them out there. If they had a tax code edition of Jeopardy, I've got 2 guys in our firm that I would put up against anybody. So, the question is, qualified business income deduction, what is Code Section 199A? I guarantee you they'd kill it. They'd kill it on that show. So 199A, in theory, was very simple. A 20% deduction. So when they implemented the 21% code or rate for C Corps, all of the individuals that owned S corporations, flow-through entities, or partnerships started screaming, well, wait a minute, how come that C Corp gets 21% and I got to pay 37%? That's not fair. So what they did was they implemented this deduction to say if you're a true trader business, you get a 20% deduction. So if you take that 37% and the income from that entity, you get a deduction for 20%. It takes a 37% rate and basically drives it down to 30%. So now all of a sudden, it's not apples and apples, but now you're getting close. One of the other things, though, you have to consider is if you're a flow-through, your net tax rate on that income is 30%. If you're a C Corp, you're paying the 21%, but then you want to benefit from the spoils of your work. So you want to take that cash out of your company. If you want to take that cash, you got to pay another dividend to get it out of a C Corp. That's another 20%. In addition, most states, including Michigan, if you're a C Corp, you have to pay a state tax. That's another 6% in Michigan. So now you start adding up all these rates, and the C Corp and the S Corp are now really pretty darn close. And I'm not saying that a C Corp is what you don't go with, and I'm not saying an S Corp is what you have to go with. All I'm saying is that there has to be an analysis to say what benefits you for your company and what's the best fit. So to get this 20% deduction, it seems pretty straightforward. A trader business, take 20%. It's not. There's limitations on wages, and then people say, well, what if I don't have wages in my company? I don't get the deduction? Well, then you get this alternative calculation you have to do on the unadjusted basis of equipment and property in your company. Made it even more complicated. Then, specialized service businesses, which they defined right in the code as law, consulting, and accounting, don't even get this deduction. What did we do? I thought we were like friends of the IRS, right? The third item is rental real estate. Now, I get that my rental up north that I rent out for the year is not a trade or business to me, right? I'm a CPA. That's how I make my living. I have this rental. So sure, I don't get the deduction for that. What about a guy that's all he does is he has rentals and he's making his living off of these rentals? Well, again, everything has to be complicated in the tax code. There's a significant amount of rules and hoops you have to jump through. But if you jump through those hoops and you qualify, you can also get the deduction on rental real estate. The other code section that has caused a lot of angst in tax preparers this year was the section 163J, business interest expense. Now, I don't really understand this either, because if you're taking out debt on your company and you're paying that interest on those loans, that interest expense should be a valid business deduction. But they came up with, we're going to limit in certain situations the amount of interest expense you can take. Again, a lot of very complicated rules, some exclusions. At the end of the day, though, if your interest gets limited, at least you don't lose that deduction. It carries forward, and you can take it in a future year. So it's not all that bad, but the whole limiting of that interest expense just kind of threw me. So making your business work for you. What kind of things should you be watching out for, and what's going to help you and what's going to hurt you if you do it wrong? Business structure, employee or independent contractor, especially in the construction industry. That's a big topic. In the construction industry, we love our yellow iron, right? We love our machinery and equipment, and every contractor knows what it's Section 179. If they don't know other code sections, they know Section 179 because they know they're getting a deduction for that equipment that they purchase. So Section 179 and bonus depreciation is a big deal. And, attracting and retaining key talent is also a big deal, especially today in the construction industry. So business structure, choosing what works for you. We talked about the C Corp versus the S Corp and the limitations and the differences. You really have to sit with an advisor and walk through what those differences are and what are you trying to accomplish in your business. And are you trying to plow back money, grow that business, then for years and years and years? Well, maybe that 21% is the right and C Corp structure is the right structure for you. If you're like, well, no, I've built up my business and I want to be able to take that money out and not get taxed a second time, well, maybe the S Corp is the better route to go. Now, so there's pros and cons of each. You really have to walk through them all, and they're not necessarily just dollars and cents decisions, right? There's a lot of other things. In an S Corp, you can have more than one shareholder, right? So you have partners, but there's really strict rules on how income gets distributed and a lot of other rules that you have to follow, and everything has to be really in sync and in alignment to that ownership structure. On the flip side, there's also the limited liability company. And when these came out, I don't know, 15 years ago, let's say, 20 years ago maybe, it was the pretty girl at the dance, the new person. It was really savvy. Every attorney wanted to set you up with a limited liability company. It was so flexible, which is true. They are very flexible, and sometimes maybe that's the better model to go with than the S Corp. But they have their limitations too. There's restrictions on deductibility, allocation of income. You potentially could be considered receiving guaranteed payments, which is income to you as a partner that you owe payroll tax on, which does not come into play under the S Corp. So again, limited liabilities are a very good vehicle to use, but again, you have to weigh the pros and cons. I put on here sole proprietorships. That's like a Schedule C in your 1040. And unless you're a very, very, very small business that has just started out, there's really no reason you should be a sole proprietorship. You have personal liability against you. When the IRS comes to audit, they have access to your whole 1040, your whole tax return. I would not recommend a sole proprietorship Schedule C unless, again, a very small guy starting out. And typically what we see is they start out, they're Schedule C. As the business grows, then we actually incorporate into one of those other vehicles, those other entities, and then get it off their 1040. So employee or independent contractor, a lot of my contractors that I talk to say, I have a lot of seasonal employees. These guys show up, they work a couple weeks, then they're gone. I really don't want to put them on my payroll. It's really a headache. So I'm just going to send them a 1099. Another code section contractors know, 179 and 1099. Well, the IRS they literally have a 20-factor checklist that somebody can go down and you read the questions and does this factor, is this factor, is this factor? And they classify those 20 factors into 3 categories: behavioral, financial, and the type of relationship that you have with the company. And after you get done assessing those 20 factors, if it quacks like a duck, if it swims like a duck, it's probably a duck, right? And people say, well, what's the big deal, right? If they come in and they say, hey, your 1099s, they're really employees. The issue comes into play that the IRS is going to say, okay, that's fine. Those 1099s, they should have been employees. So now you owe the payroll tax on that, the employer portion. But we're not going to chase down 100 1099s and assess them the employee portion. You're paying the employee portion. So now you're paying employer, employee, plus you're going to pay the interest on it because you should have paid the tax way back when. And to make sure you don't do it again, we're going to assess you a penalty. That's the issue, because that number can get really big really fast. So you really want to make sure and make sure you're documenting your employees and addressing, are you telling them where to go? Are they using your tools? Do they have to show up when you tell them to show up? Are you directing how they do their work? They don't just do their work anyway. You're directing them. All those factors come into play, say, that's an employee of yours. I know we hit this over and over and over, Section 179 and bonus. The Section 179 max is now $1 million. Bonus depreciation, which is right now 100% of anything you buy for between the periods of 2018 and 22, and then that bonus depreciation starts to phase out. The one factor I would want to point out to everybody is Section 179 has been around for a lot of years, and states actually follow the 179 rules. So if you deducted it for 179, you can deduct it for your state. Bonus depreciation, when that came in, states did not adopt that or accept it. So while you think, wow, this is great tax planning, I already did my own tax planning. I had $1 million, but I bought a whole bunch of equipment. I took bonus depreciation. I don't owe any tax. Well, that's great for your federal, but now your state, you got to add back that $1 million that you deducted for bonus and then spread that over 5 years. And now all of a sudden you have this large state tax liability that you weren't expecting. So attracting and retaining key talent. Pat later is going to be talking about labor and some of the aspects of the unions in our area. But I wanted to touch on this. Not that I want to bring up a sore topic, but 2007, 8, and 9, if you've been around, you've been through those years. Tough years. The Metro Detroit area was destroyed. And a lot of workers said, hey, I got to support my family. I got to put food on the table. And they got out of Dodge. And they went south. They went to North Carolina. And they went to Alabama. And they went to Florida. And they went to Arizona. So now when the economy comes back, we're like, hey, vacation's over. Come on back to Michigan. They're not coming back. I don't want to deal with 9 inches of snow on November 8th, right? I'm down in sunny Florida. And I'm working. And I'm providing for my family. So these workers aren't coming back to Michigan. So that really gives contractors tough trying to find workers. To do that, though, you really have to kind of think outside the box and offer additional items to attract key talent. For example, the more you have a robust, qualified plan for individuals, the better. A lot of times your workers are union workers, But for other workers, you can implement a 401k or other plans to give them incentive to stay around. To incentivize key employees, guys that you can't have leave, you may want to, and we've seen this a lot, is put in a non-qualified plan. And the reason it's not non-qualified is you're not offering it to every employee. It's select individuals that say you can participate in this plan, and here's how the plan works. The issue with the non-qualified plan is it's great to handcuff a guy and keep him around because he sees that carrot, but you don't get a deduction until you actually pay it out. So you're not going to get a current year deduction for funding a non-qualified plan, but you will someday when you actually pay the money out. But it's a good incentive to keep key people around. Something else that is starting to kind of catch is that we're seeing our clients actually offer stock awards, whether it's a non-voting share or sometimes small amounts of actual common stock, because it makes them feel like they're really an owner in the business. And it really gives somebody some incentive to take the company to the next level. You can't imagine what just giving 2% of your company to somebody to say, hey, you are now an owner here, does to the whole mentality of an individual. They feel proud. They don't want to leave because a lot of times, they're going to forfeit what that stock can appreciate to. It's a great way to do that. And then, now that we're in 2019, you just can't do enough for employee benefits, whether it's dependent care, health care, the better the health care you can provide, which all have, tax deductible components to that. So the more you can do, employees appreciate that and get them to stay. So, what's the number one event that we need to keep in mind over the next 12 months? I think I've already alluded to the fact, right? It's the election. And this cartoon is just, that's my mind when I try and grasp the election right now. There's so many people in the running. Who's in this week? Who's out this week? It's just crazy to keep track of everything. But the key is, next year at this time, I hope you come back, and I hope you're with our event next year. But at this time, we'll be past the election, and we'll know who's going to be in the White House, and that's going to be a big deal. I don't want to talk politics and who you're for and who you're against and your whole ideological political theory, but politics and taxes go hand in hand. And you can already hear it with all the people that are running for election and all the things they want to do. And they want to do it with a lot of money. And how are you going to raise money? You're going to raise taxes. So keeping that in mind is really key, because as I talked about, you need to get with your financial advisor and you got to say, what do you think is going to happen? Are these rates going to go up? If they're going to go up, maybe I pay the tax this year, because I'm going to get this really, really good rate, because these rates are not going to be around forever. Or if you're very confident and say, hey, I think this is going to continue on, they're not going to change anything, and then it's another way to look at it. For example, and I know, don't ever read anything on the internet, but I saw this last week, November 15th, and it was out of the Wall Street Journal, so it's not like, the crazy Republicans edition. This is the Wall Street Journal, and it talks about how Elizabeth Warren's tax plan would bring some wealthy individuals to a rate that's over 100%. So, as I mentioned, you'll be able to get the slides later. I'm not going to go into detail, but it was a pretty interesting article on how somebody can have earned income in 1 year, and because of the wealth tax that she's proposing, plus the regular tax that she's proposing, you take that total tax that an individual pays based on the income they made for the year. Now they're paying a rate greater than 100%. It's crazy. So this is a slide, and we haven't even gone through all the speakers yet, so you can reference this later on who you need to know out of UHY and our outside speakers as go-tos. So are you prepared? Tax planning is not something you do on December 15th. It's not a one-time a year item. You should be doing that throughout the year. You should be talking to your professional advisor throughout the year to say what's changing in your estate. What are you doing about succession planning? Capital gains and harvesting capital losses. Where does that stand? You might have a big capital gain like John was discussing in June. How are we going to deal with that? Well, maybe the opportunity zone is the option that you want to do. Well, you have to start planning for that. You can't do that on December 15th. As we discussed, the business structure. I talked to a lot of clients and they're like, oh yeah, my guy 30 years ago set me up as a C Corp and that's been the greatest thing for me and I don't need to change it and that's how I've been running. Well, that's really not the way to look at it because the whole world evolves and your business should be evolving with it. And maybe that structure is not the best structure as we talked to before. So all those items are all tax planning items that you need to be doing. Unfortunately, you shouldn't be doing them one time a year. You should be doing them throughout the year. But at a minimum, if you haven't talked to your advisor, I urge you to reach out to them if they haven't reached out to you already and start that planning process. So UHY has put together a 2019 tax planning guide. So one of the takeaways that everyone's going to get here is you're going to have a link to our tax planning guide. Again, we're trying to save the trees, be digital. I get that. I'm a paper guy. I love my paper. So you can go in, print off as many copies as you want, but thumb through it because it's laid out really great, and it'll pique your interest and you'll say, wow, I never considered this, or I definitely need to talk about this, or I know I have this issue. So it can kind of gives you some general overview, and then you can call your advisor and say, hey, let's talk about succession planning. Let's talk about whatever. It's great. Like I said, it'll be a follow-up. After the event, you're going to get a link that you can click on that. I urge you to click on it, download it, print it, whatever you want to do, but at least take a look at it. That's my contact information. All of our contact information will be sent to you post-event, so you'll be able to reach out to anybody. So now, we actually have a super secret agenda add-on. Just last week, there was a change to the sales and use tax rules for the construction industry. So I talked to our state and local expert, Sue Wagner, and she said, we've seen a lot of activity in the actual auditing of sales and use tax. And the construction industry is really unique in that sales and use tax zone and those rules. And a lot of times, people don't fully understand those rules. So Sue's going to talk really briefly about what she's seeing on these audits because, they're hitting everywhere. And a lot of our clients are getting hit with these audits, and they're going after them. Thanks.
So this is working now? Can you?
It'll kick in.
Oh, when I get up there?
But you need that.
Oh, yes, I do. Okay. The green button.
Yep.
Good morning and welcome. Thank you for joining us today. We really appreciate it. And as John mentioned, I'm going to be very brief because Lansing issued this updated Revenue Administrative Bulletin Friday. I talked to him about it, and there's actually two what we call RABs, Revenue Administrative Bulletins. One is for contractors, another is for contractors who are also manufacturers. This particular one is strictly for contractors. Last one was issued in 2016. This one sort of took even me by surprise, and I'm linked in with the state and local tax group, but not a lot of changes, but I thought it was important that you knew this was out there. And of course, contact me. I can get you copies of both the RABs, any questions, whatever. So this is more of a public service announcement because I promised John I'd take real quick, few minutes. You can always contact me. But the key things I see besides this updated RAB, audits. I do a lot of audits. I probably have at any given time 12 audits going on. And the ones that we're seeing an increase in are the contractors. And those are also the audits that I see quite a large number when it comes to the assessment. So I wanted to bring to your attention the issues that I'm noting the problems that are being caused by these audits and the headaches that you're experiencing. How many have been under audit, been experiencing these in the past? Okay, so those of you who did not raise your hand, they will find you. Okay, they're going to look for you. And there's never any rhyme or reason. If you've been audited before, they'll generally come back. But what I'm seeing now in the last year, 2 years, our contractors are like the flavor of the month, okay? A couple years ago, it was doctors and dentists. Before that, there were a lot of, my clients were software developers, and there's always the industrial processor. They're always looking at those type of organizations. So if you're a contractor who is also a manufacturer, you fall under that industrial processing. So there's a lot that goes into that also. But what I wanted to talk about is, let me move this forward. Okay, so with the sales and use tax audits, the key issues are, one, documentation. Are you prepared for the audit? And remember, an audit is always a look-back period. It's the prior activity. And in Michigan, states are all different. Most of them are 3 or 4 year look-backs. But in Michigan, they can go back 4 years, okay? So do you have that documentation? Is this information available? One of the issues I see often is, okay, we change computer systems halfway through this audit period. Do you have that legacy information? Can you produce what the auditor asked for? So what we tend to do is it's a case-by-case analysis in regards to the look-back period, the documentation you need, and the sample. What the state normally does is they'll come in today and say, okay, we're going to look back, test 2018. Maybe that's not a representative sample for your company, and there's a number of reasons, and you can contact me, and I'll be glad to share this with you. But what occurs is 2018 good? If not, we need to open up that entire 4-year span, which of course is an increase in work for you and your staff, and we're here to help, of course. But what happens is I'm going through one right now where the 1 year 2018 is not representative. And you as a taxpayer have that right to say, what are we going to sample? What are you going to look at? How are we going to take this forward and bring it current? So be careful when you sit down, because they generally make you sign, okay, here's our sample test. Okay, I agree to this. And oftentimes you can't change it later. So be careful when they come in on that. The other key area we're seeing with the audits right now are they look at credit card purchases. And what that generally relates to is anything you order on the internet. Everybody knows about the Amazon orders. Amazon's supposed to collect sales tax now. That's not always the case. So what you want to make sure is if you're ordering on the internet and you owe tax on that but have not been charged sales tax, it's your obligation to assess a use tax and submit that yourself to the state of Michigan, okay? Big issue right now because people don't always realize when that credit card bill comes in, they pay it. But you need that documentation, and oftentimes it could be by a cost center. Maybe you allocate your credit card or procurement card to individuals. Make sure they give you those receipts because we want to make sure tax had been paid, and if not, we're going to self-assess. Other item, out-of-state vendors. That's key because maybe if you're ordering from this vendor, they may not have a legal obligation to pay the state of Michigan that tax that they charged you on that invoice. And if not, again, you owe tax potentially, and you have to submit it yourself via a use tax. Two key things that I'm seeing with the contractors during the audit is the use tax is not paid. And I talk about here where the law is that ultimately a contractor is responsible for the use tax. You are considered an end user. I don't always agree with this, but it's the law. And what happens is if at the time of purchase you do not pay a tax, can you pass that on to your customer, your client? You may or may not, but the state of Michigan claims that you are the end user, meaning you're consuming what you've purchased. So you owe tax one way or the other. what I'm recommending to a lot of the contractors I deal with, pay the tax to your vendor. You're going to pass the audit. You're not going to have to worry about if you purchase something today, use it a month, 2, 3 months from now at a project, and did you then self-assess either yourself at that point in time, or did you go after your client customer and make sure they paid you tax? Okay, so it gets really tricky, especially if there's miscellaneous supplies, and you may have that embedded in your contract. What I'm going through right now is an auditor's trying to get me to prove, well, I bought X amount of items, and we use that like in a supplies capacity, so I don't use it up on just one customer. I sort of allocate that, the usage of certain tools or gases or, caulking, whatever it may be. And I'm trying to prove to her, there's no way I can take what I purchased in bulk and then, line item it to every, customer. So what we do is we add a line to our invoice saying miscellaneous materials and expense. I have a huge assessment on that right now that I'm fighting with them. But again, the laws, listed on here, and I can inundate you with laws, but basically you are responsible for tax. So understand how your systems are working, how your bids and proposals, how everything ties in regarding it, because they are just really zooming in on contractors. For this RAB, this new one that just came out on Friday, the main change is they've added some more examples to give you some ideas on how it may apply to your company. The other key point, they talk about exemptions, okay? And the main exemption that they've now added to this group is called property purchased or acquired for eligible activities in a transformational brownfield plan. I don't know how many in the room do this, but the key is now, where in the past you would have an exemption, you'd use the Michigan Exemption Certificate 3372. You would obtain that from whoever you're doing business with to exempt tax on certain purchases. Well, now with this new brownfield plan, note that you must use the form 5555 and you must obtain it from who you're doing business with. Okay, I couldn't even go out there and find a copy because normally I like to look at that before I talk about it. But you have to get this through the group you're working with. So I kept it brief. You have my information. Feel free to call me. I'll be glad to send you the RABs that impact your company. It's very tricky, but I just want to save you the grief on audits. It's just these assessments are going into hundreds of thousands of dollars, which we do everything we can to lower it, but we need to do some pre-planning in the way you're doing business and your accounting records and how you're billing and how you're paying tax. Okay, any questions? I'll be here. Feel free to come up and talk to me. Thank you.
Thanks, Sue. Any questions for Sue? Sorry, I should have did that before she walked off the stage. Any questions for Sue on sales and use tax? No.
Okay.
All right. Well, thanks. Thanks for your update. Trying to give you the latest and greatest, right? Just came out last week. All right. So at this time, it's time for our break. We're going to try and keep it to 15 minutes. We're on a good time schedule. We're not too far behind. We're not too far ahead. We're right on track. Let's take a 15 minutes, stretch our legs, get some, more coffee, more water, and we'll see you back for second half. Thanks. If we could have everybody take their seats, we'd like to get started on the second half of the presentation.
All right, we'll catch up. Good to see you.
Hello. Are we out there? No. Great. Guy back there's giving me a thumbs up.
Yeah, here you go. Got to give a CPA instructions,
What am I doing wrong?
Check 1, 2.
Hello. There we go. All right, if we could have everybody take their seats, we're going to start on the second half of the presentation. Hopefully everybody had a chance to get to the restroom and, get another coffee or some water or something. Hopefully you're enjoying the presentation so far. Now, the second half, we have some outside speakers that are non-UHY, but are good friends of the firm. And next up is Mike Kulka, who's going to be talking about some environmental and economic incentives that you can all take advantage of.
Am I live now? Thanks. Okay. Hello? Am I live? Or is it Memorex? For some of you younger people probably don't remember those commercials, but I want to thank John and UHY for giving me this opportunity. Environmental risk management, consultant remediation, maybe some people don't think of that as in the construction industry, but any of you that are savvy should know that it really is a big part of your projects being a success, especially with a lot of the urban development going on. You know, there's just challenges that we all wish we could know everything, and sometimes once you break ground, you really never know what's under it when it's been redeveloped 5 times over a century. So I presented this as a continuing education to UHY back, just maybe about a month and a half, 2 months ago. And I've come to this probably the last 5 or 6 years because I think it's a marquee event for the construction industry. I don't know of anyone else that does something like this. And if there is, don't say it, because I want UHY to continue their leadership in this place. So after I presented to it, John really, expressed that it was a good presentation, and I said, this would be good material for your construction update. I think it would be something fresh. You've got, the opportunity zones in the last couple of years, and I really think, and it's your call. What do you think? And he's like, I think that'd be a great idea. So we, in very short order, put this together. This is a version of a presentation that I give often, and I tried to cut some of components of it that I don't think you'd really care about. I don't want to put you to sleep. So when I suggested that, he said, well, only if you buy me lunch. And I said, well, that'll be a quid pro quo. Okay, a little bad joke, right? So I'm going to get going here. I have almost 90 slides, and I think at first they look at this, how the hell are you going to get through that in 45 minutes? But you'll see I talk very fast, and this isn't my first rodeo. So if you have any questions, I don't know how you're doing Q&A, but write it down and we can talk at the end. But hopefully you have questions, or maybe you don't need to because I'm so thorough that you don't have a question. Wishful thinking. So this is myself. I'm a licensed professional engineer. I've got close to 30 years experience. I've been, I founded this company almost 28 years ago, and we've grown to about 150 employees with 15 offices across the country. So as the, I'm sorry, did someone? Okay. As the firm has evolved, I've kind of come to be a kind of chief strategy officer, even though my title is CEO. And I really like bringing together teams to build a great project, and it works quite well. And I always say it's great to get your invoices paid, but going to ribbon cuttings and groundbreakings to me is just priceless. So, all right, what's new in 2019? Anyone hear of MDEQ is now EAGLE. So every governor does this, so it's not just a Democrat-Republican thing. It just seems to be it's always like a first priority. They got to rename this department that regulates my world. So it's now EAGLE, Department of Environment, Great Lakes, and Energy. PFAS, has anyone had to deal with PFAS or managing anything with PFAS in a construction project yet? No one? Well, I'm going to show you why you may more and more in the future. So PFAS is used in all these different industries you see noted up there, and like all bad chemicals, it does a tremendous job doing what it does. So it makes the Teflon stick to the pan so that the egg doesn't stick to the metal. It's not in the Teflon, it's in the bonding material. So it's used in waterproofing, plating, any type of coating type industries. Why is this a big deal? You see, benzene is something that's got a lot of toxicological data behind it, and it has a drinking water criteria of 5 parts per billion. PFAS we call it an emerging contaminant because we didn't even test for it, not even 2 years ago. So all those industries, there's probably countless phase 1s and phase 2s that never tested for it because we never had to even look at it. And it's becoming problematic in soil and groundwater management in construction projects, and I'll give you a couple examples. But PFAS, their drinking water criteria is 70 parts per trillion. I mean, you know how restrictive that is? I mean, that's like a drop in 10 Olympic-size swimming pools. So, I mean, that is a really small concentration to regulate to. Here's some examples, astronomical levels. This was at Tribar, Adept Plastics in Wixom. If you ever see that big water tower on the side of 96, they're a plating facility. 450 times what the state allows. There's all this hype about this, and I want to give you a little background on this. Here's some other ones. Rockford, there's Wolverine Worldwide. They make shoes. They waterproof shoes. They use a lot of PFAS. They were the first ones, if you ever heard about this, that made it onto the radar and in the press. The next was Lapeer Plating. Both of these companies were just handcuffed, and they incurred a significant amount of debt. I didn't update my headline, but just I think it was just last week, Lapeer Plating was sued by the city of Lapeer for $3 million to recover costs related to this. So it really is rearing its head. I don't think in a good way. I'm an optimist, but I'm also a realist. And I'm going to show you how we can solve some of this. So just to give you a perspective on this, in 2018, the state sampled, what does that add up to? It's like 2,200 different public water supplies that were on groundwater because of this big PFAS scare. Only 2 of all of those drinking water systems had exceedances of the 70 parts per trillion number. One was quickly changed to city water, and then Parchment was connected to Kalamazoo. So this is really, what's the percentage? It's really a lot of hype, and our media just likes to take anything that makes us worry about stuff, like we don't have enough with asbestos and lead. So this is an affordable housing development that we had where typically we didn't really have any concerns out here, but because it was close to Parchment, the state, it was, MSHDA's highly regulated. We had to go and do this whole study of PFAS, and it was interesting because we found all the results were just below 10 parts per trillion, which is relatively low. It's below the drinking water criteria, but this was, there was no source. So this bioaccumulates in bodies, so we could only attribute it to the humans that lived in this development all have a little bit in it, and it's probably going in the septic system. So it's really, I use the word uncharted territory. And this is kind of what we've been dealing. This isn't really construction related, but it just shows you like a low volume plater. This facility, we designed this, we did a treatment test, and they're spending an extra $3,500 to $7,500 a month. That's someone using 5,000 to 10,000 gallons per day, whereas here's a large, and you can see names, this is all public, so I'm not revealing anything. So here's a user that is using 350,000 gallons. Their cost is $12,500 to $20,000. So look at the scale on that. This regulation is going to put a ton of small business platers out of business, and the big guys will win because of the scale. So why should it concern you? I've had developments, I'm going to give an example later, where we were all ready to go. It was DEQ at the time. We had a $2 million, $3 million cleanup, and last minute, it was an old manufacturing facility. They're like, you guys got to test for PFAS. It was an extra, probably $20,000. We didn't have any, but it just shows you how this is going to become a concern, and the more you're aware of it to plan, in advance, the better you're off on your projects. So there's good ways to help pay for it. I'm not going to read all those bullets. I'm just going to go through the slides. So there's EPA site assessment grants. There's a round. This is kind of, I call it government pork because it is. EPA grants certain communities money to subsidize the cost of phase 1s, phase 2s, asbestos inspections. So there's one in the Tri-County area of Lansing. Wayne County is just about to issue theirs. Oakland County's got a little bit of money left, and then Genesee County Land Bank is also going to have one. These range from $300,000 to $600,000 to $1 million. So this is non-recourse funding to supplement the due diligence to find these issues out before you go vertical. Renew Michigan Fund. Has anyone heard of this? No one has heard of this. This is why I do this. This passed during lame duck last year. It was in December, end of December. If you ever watch how I make the sausage in Lansing, it's disgusting. Never watch it. Just eat sausage when it's done. This is $69 million that's going to be allocated towards a number of legacy environmental costs. Legacy environmental is there's no liable, viable party. So I'm going to bring up Bathy Manufacturing in Plymouth. That was a Pulte development. Bathy went out of business in the 80s. They went bankrupt. There's no one to go after to pay for cleanup. There's close to $4 million in cleanup. So we pursued funding. So this is a great tool. It just amazes me how little of the community that should know about it knows about it. So this is why, again, why I do this. There's the MUSTA fund. So if you run into an orphan gas tank at a construction site, oh shoot, I'll give you an example of this. This will pay for cleanup less a $2,000 or $10,000 deductible, and then it'll pay up to $1 million of cleanup. Pretty good, right? So here's a project that's under construction right now that is on Main Street. It's the old Billings Equipment right across from the Hyatt, if you know the area. So this was a Sanborn map that showed there was a gas tank and kind of out into the middle of the road, that little circle with the GT stands for gas tank. So we did ground penetrating radar to look for any other orphan tanks. We found the one, which you'll see there's a little demarcation, which is now in the right of way. But we couldn't access certain areas, so there's limitations that we couldn't scan this area. Well, if you see, there's a little tank that's in the area we didn't scan. So lo and behold, there's the tank that was in the 1926 Sanborn, and this is the tank we found. It was a 2,200-gallon diesel tank that this would have been a $60,000 change order. The developer would be trying to sue me because I missed it, even though my report said I couldn't do my GPR scan where the tank was. Instead, it was a $2,000 deductible. We immediately could remove all the contaminated soil, and we hardly lost a day on the construction budget. There's also a refined petroleum fund. This is relatively new too. There's a Starbucks in Redford on Telegraph in Chicago that I think it just opened. But this, it was really challenging. It was a tight deal. We just couldn't make the numbers work. Starbucks, you know, they charge a lot for coffee, but they squeeze the heck out of a developer. So, and they're whacked out on environmental worse than the biggest wacko you see at the, on stage last night. Not to go on side, they do talk about this stuff. So we ended up having to clean up to more restrictive cleanup than what Eagle would require, which I don't think our state should fund, period. Why are you funding something we're not even requiring? But they just wanted to put this money to work and show we've got this money, which is good in government, and they're worried about this certain governor's got an issue about roads. So these funds are minuscule. They're a rounding error for what they need for the roads. So we're hoping they won't touch it. Either side of the aisle wants to look like they took money to clean the environment. So this is, it's generating $20 million a year. It's for legacy petroleum contaminated sites. Another great tool. I had a developer client that was building an AutoZone in St. Clair Shores this summer, and he engaged us to do the due diligence for him to purchase it. It was an old gas station, went out of business in the 80s. Within 5 weeks, Eagle, the government, had approved $250,000 in funding out of this. So those are the only two examples I have, but I'm really trying to put the message out because the state, they just had a conference. They are telling us, please find us projects. We want to put this money to work. We want to clean up these old legacy sites. So I can tell you, in my nearly 3 decades of doing this, we have never had as robust of a landscape for incentives and redevelopment than the last year. So take advantage of it, spread the word. This is just a summary of all the funds that I just summarized, and I can send this I have it also in an infographic to John, and he can distribute it to you. But it's just a good summary that you can talk with a team when you're getting ready to do a development. What's brownfield? Okay, this is the definition in the Webster's Dictionary. I'm not going to read it. It's very boring and bland. This is how it reads in Public Act 381. Contaminated. Most people think like brownfields have to be contaminated, skull and crossbones, chain link fence. That's one way, but you can also be functionally obsolete, blighted or historic, or in a land bank. So a lot of people don't realize that. So if you're buying, land bank is considered blighted. So if you're developing on a land bank, you have an incredible opportunity to recover a bunch of costs that you all provide. It's a lot of construction related issues. Typically in a TIF project, there has to be an increase in the property value. If you have an 800,000 square foot building, you put $4 million into it for a new roof and a boiler and HVAC, that's not going to increase the value of the property. It's just deferred maintenance, bringing it to date. If you're adding a 100,000 foot addition, that's going to add taxable value. So you must have that in order to get TIF, because this is how tax increment financing works. This is why I wanted to present to CPAs, because I said this has got the word tax in it, so you guys should know it, even though it really has nothing to do with your tax return preparation and consulting. But regardless, I'd do anything to get an audience. So that's kind of how it looks graphically. I like pictures. I don't know if you can tell that. You know, accountants like these boring, oh, they're right there. Bullet points, but I like, you know, you got to see it. So like that's a vapor barrier, that green on the lower bottom. Tank removals, all the due diligence costs, these are all reimbursable expenses. So even on a small, let's say $1 million construction project, if it's got a little bit of environmental hair on it, you can cobble together 150 grand pretty easily. And that's not monopoly money, man, that's a lot of money. And it's all part of your construction budget anyway, so why not get some back? Demolition is covered, lead and asbestos surveys and abatement. I know Rich Adamo just left, but you know, he can tell you how much these things cost, and demolition is not a small ticket item. Core communities, there's 144 of them in the state. They were designated back in '96 when the act was passed, and I think they amended it in 2017. I call it kind of your armpit cities, no offense to the cities there. It's Detroit, it's Lansing, it's Jackson, Saginaw, Bay City, Port Huron. So kind of the Rust Belt type cities that had manufacturing bases. I'll also send a list of those out to John that he can distribute to you. When you're in a core community, this is what you get reimbursed for that is called non-environmental expense. Are these any things that you guys quote for the services you provide in the construction industry? I mean, look at all those things. These are all costs that you would incur if you were building on virgin land in North Macomb Township. And because you're in a core, you get it covered. So it's an incredibly powerful tool. Pictures. These are some of the things, you know, that are listed on that list. That's an incredible way to add value. It can be 10 to 20% of a construction budget that you get back to you, which is part of your budget anyway. Okay, example. So this is the MJR Theater at Maple and Livernois. It was an old Kmart worth $1 million. They built this beautiful theater. It's now worth $4.5 million. So that increment creates the extra value in taxes, created $65,000 of new property taxes. So the owner gets that reimbursed to them for 8 years. They get their $500,000 back, and then the city gets all the new revenue, and they never lost the base. Win-win, right? Some communities don't think so. So they don't think they need to offer anything because they're too cool. Not too many, but they're out there. Okay, where are we at? Transformational brownfield, which Sue brought up, and I'm glad she did. There's only been 2 of these passed, the Hudson site and a development in Vicksburg. Incredibly lucrative. You get into the sales tax exemptions. I mean, this is the main thing you want to know. This in itself could be an hour presentation or 2. If you have a project in a municipality of the sizes shown in this table, and your development exceeds the dollar amount, you're eligible. And just let's talk, because there's a bunch of all your vertical taxes. This can be easily 35% of your construction budget. And you get paid back not just by property taxes, but from the income tax of all the construction workers during construction and all the building occupants' income tax. I mean, that's incredibly powerful in a couple other ways. And they can get up to $40 million a year. So this is a really powerful tool. I call it corporate welfare on steroids. I'm not a big fan of corporate welfare, but you know, if someone's willing to invest $1.5 billion in a skyscraper in Detroit, I guess, you know, it's not going to happen if we don't help them. So give them a little injection. Neighborhood enterprise zones. I'm not going to go into this that much, but this allows you, if you're doing a residential development, to freeze the property taxes for certain durations of time. It's you know, beneficial to people that want to have more affordable housing. They can pay more for a house payment and less for property taxes. Community revitalization program. This is up to $10 million in a loan or $1.5 million in a grant. Grant is just free money. These types of projects, the loans, incredibly lucrative interest rates. First 5 years, no interest accrual and no principal payment required. Then it's a 10-year balloon. They have to be downtown, they have to be mixed use, they have to be a lot of things, but in the end of the day, if MEDC likes it, you might get approved. This just goes into the grant, you know, more of the devil in the details. Again, if you have one of these, I'll give a short summary to John, he can distribute it to you. So this is 7 Mile Livernois. I don't know if you've heard about all the buzz at 7, the Avenue of Fashion. But we got involved with this project. You know, that's the old B. Siegel, if anyone knows this area. It's UAD Jesuit and UAD Mercy down the road here. And that picture doesn't do this building justice on just how tired it was. But that's what it looks like today. They're nearly done with construction. This was able to get a $1.3 million community revitalization grant. So the developer got a check for $1.3 million. We had another 1.17 in tax increment financing. It was almost 30% ROI on incentives, and this is an $8 million project. Would you invest $8 million at 7 in Livernois? It was risky, and it was a catalyst, and it was a total success. It spurred a bunch of new developments in that corridor. This is downtown Lansing. Myers is doing this concept of smaller footprint urban stores. So this is they're not labeling them Meijer. So this is going to be called Capital City Market. This was an old gas station. It was an old auto repair. And this collectively, between all the different buckets, $2.25 million in grants, $1.5 million in CRP, and then, I guess that's it, 4.3 altogether. This is, you may have read about TCF Bank is coming downtown. They might call it Chemical Bank. They seem to change that quite a bit. But that was, that was close to over 25 million in incentives that we procured on that. Picture, another beautiful picture. And then this is the Pulte project I talked about. That was, God, I should have wrote this bigger. I think it's a total of $4 million. And this I just have a rendering because these aren't up. They've been going up all this year. Gas stations. This applies to every type of sector in construction. That was a $250,000 one. This is one that's being proposed. It was an old FedEx facility. This is actually behind that MJR theater, and it's going to be affordable apartments. It's going to be a $20 million development. So it had underground tanks, so we used the MUSTA fund to clean up the underground tanks, and then there was a bunch of demolition and asbestos abatement, and there was some legacy contamination from an old waste oil release that wasn't covered under the fund, so we supplemented that with TIF. Those are the projects we love where we can grab a bunch of different buckets to shore up these costs. This is the entrance to Michigan State in East Lansing on Trowbridge. It was a very tired hotel, and now it's this really cool looking hotel. If anyone knows this entrance, this was a very tired corridor. I'm a Spartan, so I used to be embarrassed that that was the gateway to the school. Now I'm proud. Not about football, but this is Maple and Cranbrook. It was an old gas station, and now it is a credit union branch. That was about $250,000. This is the Beaumont corner at 13 and Woodward, $3.7 million. And I can just go on and on. This is the Pearl that's going vertical at the end of Old Woodward in Birmingham. Ford Wixom. This is close to $25 million in brownfield incentives. It's a kind of big plant. So, they demoed that structure, but they never took the subsurface out. So we had $3 million of, 3 million gallons of water that we had to pre-treat before we could even start to demo the old structures, foundations, and basements. Last minute, because Adept Plastics right across the street had this PFAS issue, the city and Eagle made us test for PFAS, and guess what? It was everywhere. So in order for us to dewater, we had to put huge carbon treatment systems to pre-treat the water to below 12 parts per trillion to then be able to discharge it to the wastewater treatment plant. So that in itself was about a $400,000 change in last minute because of PFAS. And this is why I'm not trying to fearmonger you. I am surprised no one's seen this yet. Because we already have probably, well, I guess that's what we do, right? But 20 different projects where we're dealing with having to manage, and it's not a matter of liability. It's a matter of I gotta deal with this in order to develop my property. I got to get rid of this water. You got to dewater foundations. So I have another one. Well, this is it. This is in Grand Haven. So Grand Haven, it's very close to Lake Michigan. The water table's at like 3 feet. We took this old manufacturing site, tired old manufacturing site, PFAS all over the place. So in order for us to dewater, it was an extra $150,000. Now that's a rather large development, so that's not gonna, it's not gonna kill the deal, a change order of that magnitude. It's probably a $25, $30 million project. It is reimbursable. So all these costs are reimbursable using the TIF process. And there's also that Renew Michigan has $28.5 million allocated just for legacy PFAS. So we didn't get it for this, but that's because it was approved before they were putting the money to work. So this is a great way to remedy that. Why does this matter to you? I mean, how can this not matter? Do you want to be the one to tell your client that's going to be stroking checks for millions of dollars that you can bring them this kind of money. I mean, I can tell you, we've got some very loyal clients, and once you get them some free government money, they are very, very loyal. And then these are a lot of the contracts that Eagle has to access these funds. So we self-servingly, I'll tell you, have all these different funds so that we can procure the funds and then get the contracts, so you don't even have to, if we get you that $250,000, you don't even have to cut a check and then get reimbursed or deal with the state. They just hire us direct, we do the work and give you the keys, construction ready. That's just our footprint. I had to put a little propaganda in here. This is not my event, but I just wanted to let y'all know, we've got 7 locations across the state and then another, I think 8 down in the Mid-South, which is on this one. You guys are construction industry, so you should know the ENR 500. Well, they have a separate one for environmental, and we the last 2 years made the ENR 200, and so we're pretty proud of that. We think it's pretty cool. And I think that's about it. I got through that a lot quicker than I thought. Can you believe I got through 90 slides in 25 minutes? So questions, please. I don't know if anyone's got a mic, or if not, there's my contact info. You can call me or shoot me an email, and I'd love to help you out. Yes?
What are the criteria for access? One second. Hold on. I'm sorry. Thanks, John. Yeah, and my question was, what are the criteria the state uses in awarding money from those various funds to promote?
Remember I told you never want to see how they make the sausage?
Okay.
There's a whole process, and the more that we've developed a process with them to kind of do the dirty work. You have to demonstrate that there is not that liable, viable party. Typically, we're doing a phase 1, we have title work, so we can pretty easily show Bathy Manufacturing was here, they caused a contamination. You can pretty easily show that they went bankrupt. It's, you just do a quick Google search, and I can demonstrate that. So that one, they actually did it on their own. We didn't even ask for it, but they wanted to show that they were putting the money to work to such a magnitude. They're just like, this site qualifies, and they granted Pulte $1 million. So they did the work for us, but I've got some other ones. We're meeting with all their brownfield people in early January to really chart a roadmap of the easiest, path of least resistance. Their whole message now is we want to collaborate. We're not, I'm government, I'm here to help, not to hurt you. And that really is true in a lot of regards. So that's a good question though, thank you. Anyone else brave enough? Well, I guess we got, I don't know, I'm a little bit ahead of schedule. I don't know if you want to just keep on trucking. Okay, thank you.
Or not. Anyway, that's really good stuff. Reach out to Mike when you have one of these projects. Earlier the better, right? Right, Mike? Absolutely. When you're thinking about doing one of these projects, you're reaching out to him. So next up is Pat and Donna, and they're going to talk about the labor in Metro Detroit and the interaction with unions and what's going on.
Thank you.
Thanks, John.
I feel like we're like a dual, 2 speakers today. Thank you. I am Donna Pardnay. I am Executive Director of Architectural Contractors Trade Association. I represent commercial union contractors in the architectural trades, so I know our name's a little confusing. Today, I am also representing MUST, which is Management Union Serving Together, and I am the management co-chair of that organization, along with Pat Devlin, who is my labor partner. So that organization, it seems kind of where, management and union always seem to be clashing or fighting against each other, and we've seen a lot of that in the news lately with all the UAW negotiations going on. But in the construction industry, we do collaborate and work together on a variety of topics, including drug screening, safety, and in the last 5 years, workforce development. which really plays into what John was talking about. And during the recession, we saw a lot of our skilled labor leave Michigan. And over the course of the year, as everyone knows, our workforce is aging in our construction industry. So we really saw a need for that workforce development and created Must Construction Careers along with our labor partner. And really getting out to all of the schools, the counselors, the parents to talk about the other option than going to a four-year degree. So with that, we've reached out to the counselors to really provide them with a hands-on experience. We have apprenticeship schools throughout the state of Michigan representing all 17 skilled trades. So, and it's important to know as you're listening to the news and hearing about training, in our industry, we pay for it. There is no tax dollars used to build or train any of our workforce. We take care of that. We provide all the training. And some of the programs are anywhere from 2 to 5 years, but they're getting hands-on experience. They're getting a paycheck day one. We're giving them health care. They're getting a pension, and they're getting that skill for life as they continue in the construction industry. I know a lot of my contractors started in the apprenticeship programs and own their own construction firms today. So if they don't want to stay in the construction industry and working with their tools and working with their hands every day, there is a career path in the skilled construction industry. So I just think it's important to know as you're hearing, we are a private union organization, and we do provide all of our own training. So I think through workforce development, I think other key points when we're talking to counselors, we have them come out and see the apprenticeship at schools and go through that and work with their hands and their tools. Because I think it was, well, this group of kids isn't going to go to college, so we'll just have them come to the skilled trades. That's not necessarily, we have tests, we have math is very important for the skilled trades. There's aptitude tests that they have to take and really get a feel for what's going on. And also debt-free. So the students are coming to these schools and to these programs, and when they graduate and become journeymen, they have no debt. And so I think in today's environment, that's really important for the parents and the counselors as they're going through that process. In talking to them, I think another key point, and we can take some more questions, but really is the passage of marijuana in the state of Michigan. And in our construction industry, through the MUST organization, we do drug test. Every skilled trades person is drug tested on an annual basis. We have random, post-accident, pre-employment. And through the MUST organization in Southeast Michigan, we are drug testing probably 35,000 drug tests a year. In addition to that, we're doing ongoing safety. So it's not like they're going through the apprenticeship program one time, they're going, it's a continuing education, just like all of you are here today for continuing education. They have journeyman upgrade classes. They're taking safety modules. And through MUST, we are doing over 100,000 safety modules a year. So our workforce is constantly learning and earning on the job every day. But back to the marijuana. So we, MUST has a drug policy that's the standard for the construction industry. And as you know, it's still against the law federally. So our stance is, no, you cannot bring your medical marijuana card, your recreational. You can't smoke marijuana. You're going to get drug tested and you're going to fail. And we can't have, we take pride that we are a safe work environment, and we take that very serious. So it's hard to explain to some parents, and I think the kids too nowadays don't think of marijuana as a drug anymore because it's legal. But it is. If you're going to work in the construction industry, marijuana is a drug. And just a little point of reference, we had our drug provider in a few months ago, and it's a lot of the conversations have been about those oils. And well, I'm just using the oil and I'm not smoking marijuana, but I'm putting that oil on. So what we found out too is through those oils, it's not regulated through the FDA or any government program, and your body chemistry totally dictates whether you'll test positive or not. So we really steer, I could put the oil on, test negative, Pat could put it on, test positive, so you never know either. So the conversation is constantly evolving when it comes to marijuana, but just know in the skilled industry, it's against the law. You can't smoke marijuana and work in the construction industry. So those are a few things that we're doing as far as workforce development with our union partner and drug and safety training. And I'll take some questions after Pat, but I'll turn it over to Pat.
Thanks, Donna. I'm Pat Devlin, Secretary Treasurer of the Michigan Building and Construction Trades Council, and I represent over 100,000 hardworking men and women in the organized construction industry. And I was, right before we got on stage, John was a little bit trying to figure out what we were going to discuss, Donna and I, and his first question was, this wasn't going to be confrontational, was it? And I can guarantee you anything but. Our industry is unique. It takes the partnership that we enjoy with our contractors, workforce development, apprenticeship training, and like Donna said, we are constantly out there looking for good talent for our contractors to put to work. There is a bit of a fallacy on that we can't attract enough workers. We have no problem attracting the workers. We have problems, in the inner city with the criteria on the transportation is a major hurdle, math, learning, and all that. But we've created some remedial training. We put a lot of money over at the Randolph School, technical career training. I think the number was around $50 million, wasn't it? Mm-hmm. So that was by our organized contractors out there, the big construction managers and our individual subcontractors out there. And that's been a very successful implementation. However, and it was, I think Haley touched on it, one of the big hurdles in performing construction work in the city of Detroit is the 51% requirement that all the man hours have to be done by Detroit residents. And, common sense will tell you there's only so many skilled tradespeople that live in the city of Detroit. That number, nobody can really figure out where it came from. I've got my hunches, but we definitely in the future need to sit down and come up with a more comprehensive approach on Detroit resident inclusion. Unfortunately, for a lot of the trades that bring Detroit residents into the training program, it just has been playing out. They might stay 2 or 3 years if they're younger people and then start having kids. They move out to the suburbs for better schooling and all that stuff. So that's just the reality check that us and our contractors have to face every day. Unfortunately for our contractors, if they are not in the 51% compliance, they are fined, and that's unfortunate. So it's a disincentive that adds cost to the owners, and we just feel there's a better way. I've got a meeting today concerning the Ford Corktown project, and we're bringing in some new ideas. Hopefully we get credit, and the city of Detroit's going to give us, the compliance, but it's just a work-based training right on the job site. We'll have classroom settings. We're starting off with a pilot plan of about 50 students, all from the city of Detroit. And half will stay in the classroom setting, half will go out on the job site. 90% of our training is learned hands-on out in the job site. Donna touched on it a little bit around the state. We collectively spend over $55 million annually on training, which is big. We take training and safety training very seriously with the investment that our contractors put into our apprentices and journeymen out there. We want to make sure we bring them home safe every day after going to work. The overview of the industry, we are busy. We're projecting about 125 million man hours over the next 3 years. That's not even counting residential. We've got the bridge that's just starting to take off. A couple of projects that are kind of still dragging there. The tower project has been put on hold. But Ford's Dearborn is up and running. The Chrysler Mack project, FCA, started in late July, and we've already registered about 700,000 man hours on that project alone. So it's an incredible project, and we have been successful up to this point of manpower needs. But as things get busier, there's going to be quite a strain on finding people. I compare it back in the 90s when we went through our big boom. We were building Comerica Park, Ford Field. K through 12 was up and running. Our higher learning institutions were all adding on. Ford, Chrysler, and GM were all going great guns. We had the McNamara Airport terminal. It was about over $50 billion worth of work, all performed in about 26 months' time. So we were successful back then. Things were a little easier of capturing manpower. A great asset and tool that our contractors get to use is that use of travelers around the country. And when we do talk about the shortage of manpower, again, we're not concentrating on new workers. What we are short of are the experienced workers out there. So that's been challenging, and with the work situation all around the country, it's been harder and harder to capture travelers in our town. Even with the state, it usually seems like north of Saginaw, it slows down for the winter, and we can capture skilled workforce from there, but they're busy. The whole state's doing busy, and that's a good problem. Again, I was referencing all the man hours. That was just in a 12-county area surrounding Detroit. So it's a monumental workload, but our contractors have done a great job staying on top of it and manning it. I basically, on my daily job duties, meet with developers, our contractors, our owners. We entertain pre-job meetings that make sure before a project starts, everybody knows what lane to stay in. We want the owner to get his best bang or her bang for the buck. Everybody stays in their position and knows what to do. And during the course of projects, we also entertain what's called the tripartite meetings that bring in the contractor, our workers, and the owner to make sure that any little wrinkle out there gets smoothed out and the project is allowed to continue without any disruption. Donna touched on the fact that we use no taxpayer money for our training, and we have just embarked the last couple of years of making the connection with counselors in these high schools that were once, probably even less than 4 years ago, were told that skilled trades probably wasn't the way to go. They all existed on how many students they could get into college. So that's kind of been a relief for us. We're partnering with the counselors. We had 150 signed up this year to go to 5 different training institutions, and it's been an overwhelming success. The other situation we're going out to capture good workers is our Helmets to Hard Hat program, and that is it acts as a concierge of connecting returning vets to our apprenticeship programs. We have put on a full-time director here in the state, and it's been very, very successful. Right now, I think I'll turn it over to. I want to touch on one thing. And yesterday, article came down from the Flexengate project, and that was that the cost of labor and the cost that our contractors are charging for construction costs in this city are out of whack, claiming that our rates are higher than Manhattan. San Francisco, Chicago, and that is definitely not true. Now, I didn't have enough time, but stay tuned to your editorial page because I'm definitely going to answer that. It's a misconception. Unfortunately, I think what they're trying to do is tie in square footage rights with labor costs. But again, we've touched on some of the expenses that our owners out there have to face every day. Again, the 51%, the drug testing, safety training, and all that add to the price of projects. So, and unfortunately, at the end, the owner is the one that's paying it. So with that, I'll entertain any questions that you have.
I have a question for you.
Yep. Sure.
So, my dad was in the construction industry. He was a sheet metal worker in Local 80. So I can attest to the fact that construction work is hard work. I saw him come home every day, and one of the things he said to me was, "John, be a thinker, not a stinker." He'd have to take a shower because he was so sweaty. But the point of that story is, it's hard work, and people can't work till into their 60s and 70s like other professions can do. So as your workforce ages, they're getting out a lot earlier than other workers like myself that could work, into their later years. How much longer is it going to be before that's really an issue? I mean, you have to have these baby boomers starting to age out, at some point it's got to be a serious issue. I know you said it's not really that big of an issue now, but it's got to be on the horizon, I think.
Yeah. Well, our big problem out there is all industries are going through the same thing that we are. So it's a competition out there to secure qualified people, and that's been made tougher and tougher. And it's no surprise to anybody, this new generation just is a little harder to convince that getting your hands dirty and climbing ladders and being up in the air and being out in the cold and in the heat just isn't their cup of tea. And so it's that's made it difficult too.
Do you have a strategy to kind of just change the culture, big picture of how we think? I'm an engineer. I have 3 boys that are in parochial schools that, the whole chart is to go to college. And I've told each of them, don't ever think you have to go to college, where I think everyone else is so hell-bent on you got to go to college. And, the whole thing about coming out with debt, we have so many people that come to us where they have, student debt just kills them. But no one seems to want to, it's like, I don't want my kid to be in the trades, and it's all the trades, welders, everything. How do you change that narrative? And maybe you don't have the answer to that, but I can tell you, I try to do it all the time. And, I'm not too proud to work in the trades. And I worked as a roofer when I was in college, and it kept me wanting to go to college because roofing is a very hard job. Mm-hmm. So I wonder if you could answer that or comment on it.
I'll let you go.
Well, I think that's what 5 years ago when we came out of the recession, we saw that, our average age of an apprentice right now is 27. So, it's not, and we have kids in the school, we have applications coming, no one's hurting for kids coming right out of school, but it's tackling those kids that already have that skill set that we really need right now. So it's kind of a supply and demand. But I think to answer your question, we started that Must Careers to really talk to the counselors. And that's what we found is we needed to get into the schools, because when you go to your schools, that's all you hear about. What college are you going to? What college? I know my son graduated and they had like, wear your college school colors to school that day. It's like, you're taking a whole population of kids out of that scenario. Maybe they can't go to college, they don't want to go to college. And so you need to change that, the point of reference. And so we felt that the counselors were our first point of attack. And anytime, we do through Must, we probably do anywhere from 30 to 40 outreach events a month. Parents, middle schoolers, high schoolers, counselors, teachers, principals, anyone we can get in front of to talk about that and change that narrative. I wish, we didn't put a PowerPoint together because we were tag teaming, but there's a comic strip, someone's laying on the couch is like, well, I need an electrician. Well, he's in the Bahamas and my plumber's on his yacht. So.
Dave Kelton here. Just curious about immigration policy. If the election's coming up, the different possibilities of immigration policy might have on the labor shortage and workforce development.
Well, I know we've experienced some problems. We had a ready workforce over in Canada, and we've been pulling our hair out trying to get even the Canadians over here legitimately to work. It just has gotten harder and harder to bring those workers over, and it's unfortunate that their economy kind of took a little dive here. It has worked in the past. We're just not getting the success rate that we wish to get with our contractors. So
It's a battle. I mean, the whole verification and for the contractors to make sure there's valid social security numbers and everything. It's a continuous battle. I know a lot of our trades have hired a lot of Spanish or business agents to try to get out and mobilize a whole new workforce. I mean, we're tapping into every resource we possibly can to make sure that supply and demand is met as we continue to, especially to meet the next 3 years in man hours.
Good morning. My name is Tylene Henry, and I am the president of the National Association of Black Women in Construction here in Detroit. We just recently chartered. I'd like to first thank you all for all your efforts in trying to provide training opportunities to folks. A couple of things that we have noticed to be barriers for folks that would like to enter into some of the skilled trades are transportation, childcare. I'm very passionate and I am very confident that socioeconomic disparity is a lack of equitable access to ideas, resources, and relationships. And so what we seek to do is to bridge that gap, working with organizations like yours to develop relationships with folks in the community that may not know how to get past some of those barriers. And so this Black Friday, we are going to be assisting an organization called Fresh Perspective Seminars with a Black Friday Scholarship Boot Camp. The caveat is that we're not just focusing on how to get into college. We are focusing on STEM careers in construction, manufacturing, and healthcare. So if you all have any folks that have an interest in volunteering, coming to be a resource to the students and the parents that come, we really wish to bridge some of those gaps. And it's really about relationships. I probably won't be here till the end, but I'm gonna leave a couple of these in my cards on the back. So if anyone's in the construction space and we can be a resource to help you to get access to great talent that we know is out there, we would love to work with you. Thank you.
thank you.
Anybody else? Oh. Maybe I will be sprinting at the end of this thing.
Good morning. My name is Gary Broad. I didn't have a choice. I grew up in the business because my father was in the business, but I'm an iron worker by trade. And one of the concerns that I have is that when I went to high school, we had shop classes. And you learn carpenter work, you learn drafting, you learn how to work on cars. For some reason, they took that out of the high schools. Are they going to put it back in, or I just don't, nobody even understands what the trades are?
Right. That is a sad, shop class, working, auto, metal shop, home, even home ec, everything. So we have several of the trades that have started curriculum and working with different school districts. I know the carpenters have Career Connection. So it's actually a curriculum that they're going into the schools and kind of a co-op situation to replace the lack of the vocational, metal shop and auto and everything that they do. So we're trying to get into the schools as much as we can. They have, very strict curriculum, but a lot of our trades have started that.
Do you have any idea why they stopped it in the high schools? I mean, everybody had to take shop classes.
Yeah, big thing is funding. It's the first programs that go when the budget gets tight, it's unfortunate.
Thank you.
And we take advantage, of the summer as much as we can. I know we had a lot of trades that had like summer boot camps set up. So, we found funding through grants, and a stipend was set up so that the kids could get that hands-on experience and really get a feel for what the trades have to offer.
My name is David Harrell. I just want to echo what Gary said. I have 5 sons, and 3 of them are college. One is a supervisor at Home Depot, and another one, who is 28 years old, is a pizza delivery guy, but he makes about 40 grand a year delivering pizzas. Now, for him to stop and go into an apprenticeship program is such a cut and pay for him that, they've got to get this back in the schools. They've got to get kids on better tracks. They've got to give them more options and opportunities, and they got to get to them earlier, or they're going to get stuck, just like my oldest son.
Right. A lot of our apprenticeship programs, just so you know, in the skilled trade, they're earning day one. So when they come into the apprenticeship program, the wage varies anywhere from $13 to $16 an hour, and every 6 months they're getting an increase. So, yeah, and pension and healthcare right off the bat too. That's right. We're trying. Mustcareers.org. Visit.
Moses Bloom Roofing. We're finding that we're starting guys with travel pay and whatnot at, I think it's $19.50 or $20 an hour, which is, really incredible. Roofing used to be considered the best part-time job in Michigan. So the biggest problem that we're facing, though, is retention. As you spoke about, people don't want to work all summer in the sun into the winter. Now, obviously, there's quite a bit of layoff once the snow starts to fly, and we can't keep roofing. What are you seeing percentage-wise retention rates across the other trades for construction workers? Because even when we're able to hire a large group of people, we're still running into the fact that after 30, 60, 90 days, guys just don't want to do it. And the pay is there. $20 an hour. When I started in the trades as a plumber, when I was 18, I think I made like 10 or 12 bucks an hour. So what are you seeing percentage wise in terms of retention, and, how do you combat that?
Yeah. It's hard. My contractors, for every, few people they're bringing in, they had to, it's a revolving door. So what we're finding is anything we can do on the front end to try to give them a little snapshot of what the trades is all about, that you do have to be able to work in all sorts of weather. You're not always going to be inside. You do have to be at the job site at 7 a.m. No, you can't be on your phone on, Snapchat. You can't be taking selfies. You can't, you are going to get drug tested. So anything we can do to give them kind of a picture of what this is going to be about. It's not for everyone, but I think when we can explain it up front, you kind of weed out some of the people so that it helps with retention. But you're always going to have that. I think, we face it in every industry, but we have tried to do that more on the front end. Job fairs, just anything we can do to explain the situation. And I think that's why the helmets to hard hat, we love the veterans because they have all those soft skills that we're looking for. They know how to be on time. They know, they're not using their phones. They know they're going to be, drug tested. And so anything we can do to talk about those soft skills. But yeah, you weed out a lot of people. So it's constantly a revolving door, and it's that supply and demand, like you talked about, the construction industry. You're working one day and you get laid off, you could be laid off for 4 weeks. So we do a lot of teaching them about that too, because as an apprentice, they are making a good wage, but teaching them that you may not have 40 hours every week and how to make sure that you sustain a lifestyle that you're used to while you're working overtime.
We have a program called Access for All, really pointed and worked at the Detroit resident inclusion. And I notice I do a lot of mentoring. It's a 9-week program, teaching them the soft skills. And just as recent as last summer, when the roofing industry was in need of manpower, I would say, come with me. We're a block away from the roofers. We can put you right out. $16, I think, a month after that, you get a $4 vacation. I mean, that's not chump change, right? And these kids were, no, I want to be an electrician. I want to be a pipe fitter. I want to be a plumber. They all are shooting high. And I try to keep letting them know. I mean, it's a start. Once you get into that trade, whether it be the roofer, the iron worker is another one, hard to man up. They're just very rigorous trades that hard, and you're out in the elements and that. But the expectations, and I think Mike hit on it, how do you change that culture? Everybody wants to be an electrician, everybody wants, but not everybody can be. But I thought one of your trade, especially your trade, was a good introductory. Are you going to like it? Are you going to like being outside in the summertime or out in the wintertime? It's a good introductory trade, but it's just been hard trying to get these kids to go your way.
And I think another thing, the career path is really important too. Not like I have a lot of contractors that started as the apprenticeship and now they own their own company. So I think the stigma too, the culture that that's all you can do. You're going to become a roofer and you're just going to be on top of a roof for the rest of your life. Well, only if you want to be. There is a lot of opportunity. You can become a project manager. There is a career path in the skilled trades. And a lot of our apprenticeship programs, when you go through it, a lot of them are already graduating. We have partnerships with community colleges, and they're getting their associate's degree. So it's not like one or the other. And I think again that becomes a topic of conversation when we talk about the culture shift.
Well, that was the point I was going to bring up. Myself, I was able to go to night school on GI Bill and an iron worker during the day. But the other benefit of being in the trades is that, let's say you don't like the winter here. Well, you can go down south and go to work down there. Once you have that journeyman card, you can leave town and go to work wherever you want.
And that's one of the big compliments we hear in Southeast Michigan, get all the time, is that our workers that do go out in those settings to other states to work are second to none. I think our training is excellent here in this state, and that's proven out. I know Mr. Ricolta from Walbridge, now Ambassador Ricolta, always referenced that he could take his crews anywhere and still make a profit because they were that good. So I think it was a testimony of both the good contractors and the good workers he employed.
Ken Bresser with Amplior Recruiting. My partner John and I are very well rooted in the immigrant communities of Detroit, Hamtramck, Dearborn, trying to match reliable immigrant labor with good companies. Regularly get people coming to me who are very good workers, clearly, but they lack the English skills to get a good job. Some of them are, I've had a number of electricians come to me, and I turn them away in many cases because I can't place them. Typically, they speak Bangla from Bangladesh or Arabic. And I'm wondering if there's a path, a route for these immigrants with these particular languages to get trained in the skills. I think many of them are very intelligent. They have training back home, but they lack the English to apply it. They can't transfer their credentials from Yemen or whatever. Is there a pathway for these immigrants to get training and get jobs? And by the way, many of them are Detroit residents and would qualify to fit that 51%.
Would qualify for a 51%. We're working on that. It depends on the trade, and I know a lot of the international unions have that is a huge topic of conversation. I know a lot of our training, even in Southeast Michigan, is dual. We have it in Spanish as well, but looking at other immigrants in our workforce is constantly changing. So that is something that we're looking at and relying on our international unions and associations to help us as well, because Pat and I are both part of national associations, and we see that from California to Arizona, Texas, all across. So we're working on it. We don't have the answer. We do have the Spanish, but as far as other right now, that is a challenge that we have. We'll have to get your card. We're always looking for partnerships and collaboration, anything we can do to help the skilled trades. All right. Thank you very much.
Thank you so much.
Wow, that was some great dialogue on a very important topic that affects all of us. So I appreciate everybody's comments. That was really great. Appreciate Pat, Donna, Mike, all our outside speakers. So kind of to wrap up the session today, let's kind of circle back. Remember, if you signed up for CPE credit, we'll have certificates for you to take with you to verify your credit. They'll be back at the table on the outside. If you have a question on one of the presentations that's already happened that maybe you've jotted down a note for, we'll kind of be lingering here for a couple of minutes, make it up, ask your question directly, or keep an eye out for our post-event email. That'll have the availability to email any more questions. And like I said, if you email me a question directly, I'm going to get it answered. I promise you I'll get it back to you. There'll be a link to this video if you so choose and want to review it. The feedback survey is really, really important. I really hope you take time to answer that, because I look at every one of those and it helps to build a better presentation for you guys. So please, feedback is important. I talked about the link to our tax planning guide. Definitely check that out. Put a lot of time and effort into that. It's a great document. And like I said, don't use it as your source, but use it as your roadmap to generate some ideas so you can talk to your tax advisors, this upcoming season. Oh, and the last thing is pre-register for 2020. We're going to be here again. We'd love to have you. We're going to jam-pack this room next year, and I appreciate everybody coming today. All the speakers, the outside speakers, our event staff, they were tremendous. The DAC, can't go wrong, right? Top notch. I appreciate everybody showing up, and have a good day. And we'll see you next year. Thanks.